Okay. Let me share this. Screen is visible, right? Okay. So to just quickly tell you what was the thought process yesterday. So yesterday we discussed a investing based system which was completely objective. Like the computer can tell you either to buy or sell, right? After that, then we discussed uh, the R2 system, which was also complete. Then we discussed the event trading. This is also completely objective, like what to do, what to do, how much stop loss, how much target, everything is predefined. So you don't have to. This is called completely like 100% systematic. This is also 100% systematic. So this is the third system which we discussed. Then we discussed 4 patterns. So all these are also 100% systematic. So basically, this is not a system. This is basically to filter out stocks and use patterns on them. Okay. So now, wait. Yeah. So basically, most of the systems are 100% systematic. But as per my past experience, I have found out that in certain systems, some discretion is necessary. Like it is mostly systematic, but 20% discretion is necessary because the computers do not understand the markets. They'll tell you, okay, you tell, okay, buy about this level, they'll buy, sell below this level, they'll sell. But there are certain things which, as a trader, with experience, only you have better understanding than the computer. So certain systems, for example, the Bank Nifty intraday system, I have kept it 20% discretionary. Like I like to trade as per my view because I have observed Bank Nifty for almost last 5 years every day. So I have developed an understanding about the instrument. So sometimes I come to know, okay, what is going to happen in Bank Nifty. So I take my view accordingly. Okay, so let's get started. So yesterday we spoke like what happens if the day high breaks, day low breaks. But if the market opens within previous day range, this is a violent plot, which basically the dot line is the median values. You can read this online if someone doesn't understand. So basically, you can see that the majority of the distribution is around this is the interquartile range. So basically, the majority of distribution is around the median only, which means whenever the market open is within previous day range, we can create straddle triangles and make money. So what I mentioned, opening within previous day, chances of range bound, but breakout can happen anytime during the day. Okay. So this is one thing to keep in mind, that whenever the opening is within previous day range, we should look to create straddles or strangles, basically non-directional view. And you can see that the systems which we are discussing are different systems. So the event trading system was based on volatility. The directional system was based on momentum and price. And the other systems, this system is based on time value. So we are trying to capture, so all systems have different risk to reward characteristics, and that's why you like do them together so that your drawdown is at minimum. Most people, what they do, they only play directional. So if the market is sideways, they lose money. But you're playing direction and you're playing sideways on the index, you're doing volatility trading. So like your direction, basically all the systems are non-correlated, not related to each other. So if the momentum system is work, the sideways system won't work, right? Someone said, is this for expiry or end day? This is for any all days. We have to look for particular stock plot. We can't generalize. What? This is only for the index. See, I do non-directional trading only for the index. I don't do for stocks. because I want to do heavy volumes and I cannot do heavy volumes in stocks. Ashito, is it clear? Yeah, important to have multiple strategies. So you can see like we already discussed multiple strategies which are non-correlated. You are doing directional trading, you are doing volatility trading, you are doing also time like trying to capture time value. This is basically to capture time value. This is not a chart, this is a EOD. Like what I did is stocks which open, like not stocks, index. This is basically bank nifty only. If opening was within previous day high and low, which means open is between previous day high and low, I plotted the daily returns and plotted a violent plot of the daily returns. Is it clear? Purvi, like how will it be applicable to all time frames? This is the daily time frame. In the basically, hello, Purvi, is it clear? No, not inside bar weekly chart. Just come to the daily chart. I am talking only about the daily chart. If open is PDL, PD is the day, right? Previous day range. If open is within previous day range, then chances is market is down. So this is a volume plot of the daily returns. So see, when I build a strategy, I don't directly jump to building a strategy. First, I see, okay, does building the strategy make sense? So by this volume plot, I can say, okay, market is mostly range bound only. So now let's build a strategy around that. The x-axis is the daily returns. -4%. Daily return, how much the percentage change of that day? You can see majority of the time, the distribution is between +2 to -2. And majority is around 0 only. Is it clear? This is for the daily time frame. How many year of data this is? This is 4 years of data. See, when I say Bank Nifty data is from May 2016, weekly expiry. Okay. So this is for 4 years. Okay, so let's go ahead. So this is when market opens within previous day range. Then I check what if market opens outside previous day range. Like, so if market opens outside previous day range, this is the violent plot, which means the majority distribution is still around a central median. But you can see it's skewed on the right side, right? It is skewed, which means there are big moves also. You can see 10% move is also there, right? But I can say fairly like 60% of the time it is sideways, but 40% of the time it moves big. Is it clear from what the image is trying to say? Yeah. So okay, so I have these two graphs. So now I want to build a strategy around it. So see, this is the equity curve if there is no condition on the opening price. But this is EOD. EOD as in, so what was the logic is whatever price the market opens, create a straddle and exit at close. So for example, Bank Nifty opens, the code was written in such a manner that Bank Nifty 30,000 straddle will be created at open and it will be exited at close. The back-to-back 8 losses are also there if there is no condition on the open price. And the equity curve is decent. But this is EOD basis. Is it to look by like opening well? I didn't get your question, Rajeshri. I'll discuss this. That's what we are going to do. We'll discuss that. We'll discuss the system. I'm not come to the system yet. So like wait, I'll come to that. Like we have not discussed the system yet. Yeah, there's a cumulative PNL and BNF points. But there are two drawbacks in this chart. I'll ask you all only to figure out. So this is when there is no condition on the open price. You can see that the equity curve is good, but I said back-to-back 8 losses are also there. Does anyone has the psychology to suffer back-to-back 7 losses and be in the trade? But good systems like even have such losing trades. But what if I have no condition on the open price? So what I found is like the equity curve is almost similar only. So what this is telling me that even if there is open, there's no condition generally bank nifty is sideways only. Are you can you make sense of it? What I'm trying to say? Yeah. So which means, okay, when the market is opening within previous day range, market is sideways. But when even if the market does not open within previous day range, sometimes it is like, most of the time it is sideways. There are big moves, or most of the time 80%, 60% it is sideways, right? Is it clear till now? Then I'll come to the strategy. Okay. Okay. You see, there's no condition on the open price, and this is it. But can anyone tell me what are two drawbacks in this equity curve? Like I won't say drawback, but actually we won't be able to do this. What are two drawbacks? This is the EOD chart. Like if you take the trade at 9:15, exit at 3:15. What is the drawback? Slippages, everything has been accounted for. No, like no, that is not the point, Saloy. What is the drawback? Because we are considering EOD data only, right? What are we missing if you are doing only EOD? There are two drawbacks. No one, no, even yeah, gaps, that is fine, but yes, yes. But like Soloy pointed one point right. So this is a EOD graph. So this is showing average losing trade is minus 33. But intraday, it could have happened that the trade was minus 100 also, but eventually it closed at minus 33. But if we are in front of the screen, we'll panic and exit, right? So first thing is that the losses. So so it could have happened that when there was intraday a big loss, but eventually it closed in profit, so we are showing a profit, right? But intraday, if there was a big loss, we would have exited. Is the first point clear? So that is the one drawback. Second drawback is, it could have been that intraday the trade was in profit, but at EOD it closed in loss. So we are showing it as a loss, but actually it was a profit. Are both the points clear? Yes. So both the points are clear. So okay, so both the points are clear. So what I did is, so we tested this on an intraday basis. But on intraday we did, if the intraday PNL exceeds minus 50, cap the loss to 50. Profit we didn't cap. Is everyone getting like what like how are we doing it? So this was you can do this also, but then you don't have to do anything. Like you have to wait till close, even if the trade is in loss. But practically, can you do it? No. So two things, like we figured out that okay, market is opening within previous day range. It's a good chance to market will be sideways. Even if it opens outside previous day range, there is direction movement, but not all the time. So we tested this on EOD beta, EOD data. Okay, so now let's build a strategy around it. I'll show you some more graphs also. Which chart, Solai? So let me just share my screen. So we have named this strategy Snorlax. I think most of y'all, if you know Pokemon, see Pokemon or understand Pokemon. So basically, Snorlax is a Pokemon who sleeps the entire day. So in this strategy also, we don't have to do anything. Like once we create a non-directional view, we just have to wait the entire day. We don't have to do anything. So what, there were two drawbacks in that image, right? So basically, see, and this is the C premium at start. But then what you can, in this case, the PNL is, because if I am in front of the screen, I won't let my loss go more than minus 50, right? You can see this, the trade went till minus 305 point loss, but we closed at minus. So this is on a intraday data, 1 minute intraday options data. Are you able to understand what was the drawback in the EOD chart? I won't say drawback, but it is practically difficult to implement it because you will jump into the trade and exit the trade, right? So then we did it on minute by minute data. So to generate some insights, okay, so I figured out something, okay, I can do this. Like I have got some insights from this. You can see this. So this is the equity curve day by day. I want to figure out which days to trade and which days to not trade. So this is the equity curve Monday, Tuesday, Wednesday, Thursday, Friday. So on the basis of that, I have figured out something which we will discuss. Is this clear why I'm doing day wise? No, not all days there is theta decay, right? Everyone knows the theta decay curve, right? What is the theta decay curve? Everyone understands the theta decay curve, right? No, not about ATM, like how the decay happens. Yeah, so the decay, like it is like, I think you can, if you can, if you can see this. So basically, this is how the time decay happens. It is not linear, like every day 20% it will happen. So initially it will slow, but as we come closer to the decay is very fast. Yeah. So this is what the decay. So that's what I wanted to understand, and I did some analysis on that. So now just let's discuss the strategy. Okay. So we discussed this much. Okay. So till now, all the strategies which we discussed were 100% systematic, right? 100% systematic in place, clear exit and entry rules. But this is the only strategy which is 20% discretionary and purposely kept it discretionary. I tried doing 100% systematic, but the results were not good. And I like tried to keep 20% discretionary because like Bank Nifty or like index is the instrument which I follow on a daily basis. So I have some insights which I try to incorporate in it. So wait, let me show you one more thing. As I said yesterday, as a trader, we have to evolve. We have to keep learning. So see, I maintain a learning sheet. Like whatever I learned this in a day, like if there's something new I add to this sheet. You can see there are a lot of learnings I have mentioned. So on the basis of that, my understanding about Bank Nifty has improved, and this is applicable to all, like all whatever stocks you trade. Every stock moves in a different manner. So you have to keep looking at those stocks daily to understand how to see. So Reliance will move in a different way. HUL will move in a different way intraday. So see what is discount become premium implies short covering started. So you can see many times I tweet at 1:30 that a market can close at day high. So there are a lot of things which I keep following. So like I have noted this like over years. So if you can see, so a lot of things I have mentioned. I'll share this with you all. So over years, and then I created some rules also around it, like what to do. Right? So always let it this be in front of your desk so that you always know, okay, what to do, what not to do. Right? Yeah. So you can see, take all system in high probability trades. As a trader, you should take only few trades. If you're just, if sometimes it happens like even till 2:30 we don't do any trade, but it's fine. If your front of the screen does not mean you have to press buy or sell. All days are not meant for trading. See, maximum at a time. So journal the trades, compound the gain. So all these are important and cumulatively will make sure like how successful as a trader you are. Right? These are certain learnings with time. You can also note your learnings, and so that's why I've purposely kept it 20% discretionary, because the what is discount that we'll discuss later, Sandeep. So that is basically the discount between the future and the spot. So if the future price is less than the spot price, which means the future is in discount. So if it becomes premium, then the discount has started to become premium, right? So that sometimes that gives some indication. So this is what I've observed over the years. So that's why purposely, due to this knowledge the system, computer cannot have. I'm trying like how much it can learn. Still, like that's why I like to make it 20% discretionary, and this is what like actually is my edge, I would say. Okay, so now let's start. So intraday, it's not necessarily BNF. You can do Nifty also. I have mentioned BNF because I trade BNF and I have data. Like in Nifty, on Nifty, I have only 1 year of data. So testing, like as I said, you need a law of large numbers, right? I cannot test a strategy for 10 days and conclude okay it is good or bad. I need enough sample, enough data points. So that's why it's on Bank Nifty. But Bank Nifty, let me tell you, like it is a very volatile instrument. Like if you do not like roller coasters, or if you cannot handle that volatility, like it's best don't do Bank Nifty. Bank Nifty is like not everyone's cup of tea. Like I know people like who cannot handle Bank Nifty. So it is very tricky. Like it is very like it moves very widely. But I like to trade Bank Nifty because I've observed it like from the start. I'm observing Bank Nifty only, so I understand Bank Nifty. So I like to trade Bank Nifty only. So you can do Nifty. You can do similar if you want like a little like less payoff and less risk. You can do Nifty. So concept is same. So can we like proceed, or anyone has any questions? So this is 20% discretionary, but it's like better if it's kept discretionary. If you want, you can automate also, like keep it 100% systematic also, right? Okay, so first thing is strangle. No, so this is only Snorlax, but in Snorlax I do certain other things also. So this is like I would say 80% of Snorlax. Abhishek, yeah. So okay, so first, so basically we found out that we want to basically creating shadow strangles is gives a good result in Bank Nifty or index. So okay, so first thing is strangle with a slight bullish bias. When we say strangle, we say sideways, right? But I am saying we'll create a strangle with a bullish bias. So what do I do is, for example, patterns, if they, for example, if I get a previous day high pattern, previous day high acceptance, like the previous day high breaks, PDHS, like previous day high breaks and sustains. So what is that saying? That a market is bullish, right? See, this will take time. So like because like it's actually very difficult to explain in a manner, but I'm trying my best. So just so listen to it properly. So basically strangle with a slight bullish bias. So let first there are three things: bullish bias, bearish bias, or neutral, right? So now let's start with the bullish bias. So when will I be bullish? If the market breaks previous day high and is sustaining, okay. So I am bullish now. So I'm bullish now. So I have first option is to buy futures, buy call option. But no, I don't want to do any of that because I know decay happens. So what will I do is I will sell a put with a higher delta and sell a call with a lower delta, which means my delta is positive, right? So what I have written, don't ask any questions, just first read. We need to sell PE with delta 0.6, 0.7. You don't have to look at the delta actually. Basically, what I'm trying to say is the put option you sell should be nearer the spot and the call option you sell should be far away from the spot, right? So let's take an example. For example, Bank Nifty is at 29,400 and I have a bullish bias. Then what will I do is I'll sell a put that is closer to the spot 29,200. Someone will say why 29,200? So that you can, so that comes according to my judgment, like what I feel Bank Nifty won't go below. So, or you can look at the OI data, anything, but basically the goal is to create a bullish bias. So I'll sell a 29,200 and I'll sell a call which is why 30,000, because I think that 30,000 is the resistance. Okay, I'll do this. Stop loss is 20 points. If you're doing strangle, stop loss is 20 points. But till the time stop loss is hit, we'll manage the trades. So how the trade management, I'll show you. So we manage the trade by rolling up the CP until the stop loss hits. So as I said, it's difficult to write the adjustment now, but I'll try my best. And one day, like whenever I do, I'll share the live trade log also. Is this slide clear? Then I'll explain with an example. Why? So first, why I am selling put if the Bank Nifty is bullish? Because Bank Nifty, even if it's bullish, does not mean it will go 1,000, 2,000 points up. It will go 300 points up. So if it's going 300 points up, uh, why not take benefit of theta also and delta also? So what I am doing is Bank Nifty is bullish. No, not capping the profit. If the Bank Nifty moves in one direction, I will lose also. This is not capping the profit. I'm doing it together at the same time. Yeah, stop loss is together on the combined. No, this is just an example. Initially, so what I said, you can sell 29,400 also or 29,500 also. So you sell a P. Basically, the goal is to sell a P with a higher premium and sell a call with a lower premium in simple terms. And you have to manage the trade till the time stop loss is hit. It's on combined. When I say stop loss on a straddle, it's the combined stop loss, not on individual leg. How will you keep a stop loss in the individual leg? 10 rupee stop loss will hit in minutes in Bank Nifty. In one candle, it will get hit. Combined. So let's do this with an example. This is slightly like, I won't say it's very easy to like actually implement, but let's see like if you all can understand it. So assume, for example, previous day high, previous day low, CMP. Suppose previous day high is 3,200 or for example 30,000, and previous day low is 29,500. Okay, CMP is for example 30,000. Okay, CMP is 30,000 and Bank Nifty is following a pattern in which it breaks the previous day. So it is a previous day high breaks and sustains, right? So now what will I do is, so now I'm bullish on Bank Nifty, right? But Bank Nifty I'm bullish, but I want to capture theta also as well as delta also. So what will I do is, so basically I'll sell an option, for example, Bank Nifty 3,100. Suppose I'm selling 29,900 put P. Why? Because 29,900 P could be the day low or whatever it is. As per my understanding, that Bank Nifty won't go below this level. Okay, as I said, that is the discretionary part. And I'm selling 31,000 call. So premium I'm randomly assigning. For example, premium this could be for example 300 and this is for example 100, right? So basically you can see now what will happen. Suppose bank nifty goes in my favor, suppose bank nifty from 30,100 goes to 30,500, right? So anyways I had created a bullish view, which means by bullish view because the delta of the put is more than the delta of the call. After some time it could have happened that the trade would have become delta neutral. Like for example, if bank nifty is at in the center, like bank nifty price is near the center, then it could have become delta neutral. And generally how does the market move? It goes up, it stays sideways, and then it gives a big movement, right? So in this case, if my view is right, like if I expect bank nifty to go up, then I don't have to manage the trade, right? So when do I have to manage it? So if you just do this trade, what is my break even? So I'm getting a 400 point credit. So my break even is 29,900 minus 400 on the downside. And on the upside is 31,000 plus 400. But this is on expiry day. Intraday things will change. So this is what it looks like. How 20? Yeah. So yeah. So this is what it is. So basically this is my break even. So what I do is, so when I create this trade, first of all, I'm selling this put because as per my view, bank nifty won't go below this level, and I'm selling this call because I think till 31,000 bank nifty will at 31,000 bank nifty may face resistance. So if the trade goes in my favor, right, then I don't have to manage the trade, right? Because I had created the trade with a skewed delta. If the trade goes in my favor and the market becomes sideways, this will become a delta neutral trade after some point, right? Till now, everyone is clear what I'm trying to say. Yeah, because this is not easy. This is difficult, I would say. This is, yeah. Because there is some discretion involved, and without discretion, it's difficult to make money in this trade. Yeah, we can collect premium also. Yeah. So basically, but see, what normal people do is they will sell a straddle at 30,100. But why to sell a straddle if my view is slightly bullish? Abhishek, why are you jumping to gamma and all such things? Where did gamma come into this? Where did gamma come into this? So we are selling both, right? So how does delta neutral and gamma is affecting the trade? Yeah, okay, Kiran, I'll explain. So see, if you create a bull call spread, what happens is, as per my understanding, bank nifty on an average decays 20 points. If so, basically there's a 20-point decay. But if we create a spread, what happens is, in a spread you can make money if you carry the position to expiry. Intraday you will get only 4 or 5 points. But if we do this, we can get 20-30 points. You can try it, Kiran, creating a spread. But I have tried it. The spread does not give much money. Is it clear? So basically till now what we did, we are selling a put, we are selling a call, but we are trying to keep delta of the put higher, delta of the call lower. Why? Because our view is bullish. And as the trade goes in, so in this case, now I already know my break even, right? So what I do is when I create this trade as a risk management practice, for example, 29,500 current price could be, for example, it's at 50 rupees, assume. So what I do is I keep a stop loss at whatever the day high is for the day. For example, the day high was 80. So I'll keep a buy stop loss at 80. And suppose this is, for example, uh, 30. So in this case, I'll keep a slightly away stop loss because my view is bullish. So even if this goes up, it's fine. So I'll keep a stop loss at, for example, around at 70 only. Yeah, okay, Deepak. So is this clear? So what I do is first I create a triangle as per my view, whatever my view is. My view is bullish, so I'll create this triangle. But when I create a triangle, see, you have to understand option selling, there is a risk. So I know my break even. So what I'll do is I'll keep a stop loss. See, what people do is they keep a stop loss on the option premiums, but what happens is in a spike you'll be thrown out of the market. But what I do is instead of keeping a stop loss on the premium, I keep a stop loss on the wings. Okay, so this will be bought when it comes to 80. And when will this come 80 if the market falls? And when will this come 70 if the market rises a lot? And I'm keeping this stop loss far away, right? Because my view is bullish, right? Even if the market goes up, it's fine. This will get, I don't want to like get this executed and pay theta. So that's why I'm keeping a stop loss far away in this. So on the put side, you can keep at day high, but on the call side, you can keep slightly far away. In this view, if your view, like whatever your view is, like my view is bullish, so I will lose if the market falls. So on the put side, let's keep a stop loss at day high. When the day high will get triggered when the market falls, right? So for example, what happens is Bank Nifty falls and my put gets triggered, right? And Bank Nifty comes to, for example, 29,900. Still, so what, till the time the stop loss is triggered, what I will do is, for example, if I'm creating this view, I expect Bank Nifty to go up. But if Bank Nifty is coming down, I'll shift my call downs. Okay, I'll shift 31,000 to 29,900. I'll shift it to 29,800. Okay, till the time the stop loss is hit. So basically what I did is, my view was slightly bullish. Okay, so my view was slightly bullish, so I sold a put with a higher delta, a call with a lower delta, right? So now in this case, see, what if you do a straddle, what happens is you have to manage both the legs, because one leg will become in the money. But I'm not creating a straddle because my view is slightly bullish. So if my view is bullish, why not sell a put which is near and call which is far? So for example, it happens. So now I know I have to manage if Bank Nifty comes down. If Bank Nifty goes up till a certain price, I don't have to manage. But in a delta neutral thing, you have to manage on both sides. So now what will I do is, okay, now I have my plan ready. Let's keep a protection stop loss order so that in case a very wild swing comes, at least my loss is capped. Okay, Bank Nifty is going up. I don't have to do anything. If Bank Nifty comes down, I'll shift my roll my calls down. Okay, and at one point it could have happened that like Bank Nifty comes down, but your stop loss is not triggered and Bank Nifty is sideways. So you can get premium like theta decay on both sides. Sometimes it could happen that the stop loss is triggered, but by the time stop loss is triggered, you can keep rolling your call down, but you have to make sure loss does not exceed 20 points. But by not keeping a stop loss on the premium, what happens if you keep a stop loss on the premium and you're trading huge quantities? What happens is this 320 will get executed 400, again come back to 380. If you're trading huge quantity, you will pay huge slippages. So that's why I keep stop loss. And so if you do this, I already, my max loss is capped, right? If this protection gets like bought, my max loss is capped and I can shift the calls also down, right? So till now, is everyone clear? Then I'll explain in Opstra also. How to determine the stop loss, I don't know. How the rolling is done, can you explain? Okay, so I'll do that only. Wait a second. That we will come when to do. Let me just show you. Okay, now let me ask you. My view is bullish on Bank Nifty. Bank Nifty is 21,500. I am bullish. So what will I do is I'll sell a put of 29,200. Wait, huh? Oh, there's someone with the name dash dash. Uh, like who is it? Or else I'll have to like make him exit. Who is this dash dash? Guys, join with your name only, right? Okay. So wait. Okay, so let's do one thing. Can you explain? Okay. So I'll can you take we take a Wednesday Thursday. We'll discuss this. Okay, so let's again do it. Okay. For example, let me okay, okay. So this is the suppose this day, right? What happened is market opened up on previous day high, right? Okay. So suppose if you are bullish, so you will go bearish below if it closes below the previous day high. So what will I do is, so I know I will go bullish. So this day high, previous day high is 20,200. So I'll sell a put which is below 20,200. So for example, 20,100, right? And I'll sell a call which is far. So I'll sell a call, for example, Bank Nifty, the price at that time was 20,600. So if I'm selling a 200 points away put, 400 points away put, I'll sell a call which is, for example, this was 400. So I'll sell 1,000 points away. Suppose I'm selling 20,700. What is this? 20,000. Okay, 21,000 I'm selling. Okay. So I'm telling 21,000 call and this put. Why? Because my view will change if Bank Nifty closes below previous day high, a previous day high below if it closes. If it does not, I am bullish only, right? So what happened is I create the trade here. You can see that till this time the trade moves in your favor. You would have captured delta also as well as theta also, right? Right. So what happens is, yeah, someone asked how do you roll up and roll down? Suppose Bank Nifty comes here, it is going up. So as soon as it reaches 20,700, this 21,000 call is in risk, right? So what I'll do is I'll shift the put from here to a level which I feel won't get broken, right? So for example, I can shift to here because I expected Bank Nifty reverse from here, so I'll shift to 20,400. As soon as the market goes up, I'll keep shifting it. And even if there's a wild move, I have a stop loss protection order, right? Is this one point clear? Like what is being done? This is like little tricky, I would say, and like it's better being if I do it live only. Like, no, shifting means, see what happens is, let me show you. Assume I am bullish, so I am what I'm selling a 21,000 put. Bank Nifty is at 21,534. I'm selling a 21,000 put. So you can see my put premium is 750. If I'm bullish, I'll sell a call which is a slow premium, which is less than. See, this is basically a bullish position because my put delta is more than the call delta, right? So I create a view like this if I'm bullish. So you can see on the upside, my break even is 11%. On the downside is 7%. So basically, I'm bullish. That's why I'm creating a view like this. So if you can see in this case, my break even is 24,000. So intraday, what will I do is whatever my break even is. So suppose if I buy the 24,000 call now, is at 140, 150. So what I do is I keep a stop loss on this, for example, at 300. So whatever the day high is, I keep the stop loss for that day. And the same, so for example, market moves violently and this gets triggered. Okay. If this gets triggered, so what I do, by the time it gets triggered, I'll keep shifting the put up. So I'll move 21,000 to put to 21,500, for example. You see, on the upside also there's no loss. So are you able to understand like what I'm trying to do, like why I'm doing these adjustments? Yes, by shifting, yeah. Basically, by shifting, I means I try to keep my overall delta positive only. So what happens is, for example, I'm selling a put at 700 and call at 300. After one point, it could have happened that the trade could have become delta neutral. So again, if my view is bullish, I'll keep my put delta more than the call delta, and I'll keep shifting it the entire day. But what happens in Bank Nifty is the by some time, like at one point of time before two, the movement is generally sideways, so you can capture the time decay. I'll again explain, but is it slightly clear? So see, by 9:30 the day high, there is some day high or day low, right? I like again explain. Yes. Yes, see what most people do is, so the prop desk which I train, so basically what they do is they do only delta neutral. But the problem in that is like you have to constantly manage your trades. In this case, when do I have to manage my trade? If the trade goes against me, right? If the trade is going in my favor, I don't have to manage. But suppose I create a 29,400 straddle here. If the market goes up, I have to manage. If it goes down, I have to manage. Yeah, I'll do that, Abhishek. So first thing is, as I said, the discretion part is selecting which strikes and what view to take. So view I told you, you can take it using patterns, right? So for example, I am getting a bullish view. So what I'll do is I'll sell a put and then I'll sell a call. But if the put delta will be higher, the call delta will be lower. As the market, but I keep a stop loss order at my break evens. As the trade goes in my favor, I keep trailing the stop loss. I keep shifting the puts up. And for stop loss on the protection orders, you can keep the stop loss above the VWAP of the individual option. So, and this is the chart which I use also. So for example, what I do is, see, there are a lot of dynamics involved in this. I'll explain like whatever I can. See, so what I do is when I'm selling, creating a trade, this is April. The magnetic lens, 534. So see, as a seller, suppose I'm selling these two strikes. This is I chart, 21,000 put and 23,000 call. So what I do is once I load in this, as a seller, what do I want? Do I want a graph like this? Do I want a graph like this if I'm a seller? This is basically the combined premium of both the strikes. Do I want a graph like this or no? No, right? I want a graph which is going down. Yeah, how Sarvesh? Yes, I don't want a graph like this.
You want the premium to go down, right? If you are a seller.
Premiums are going up, right? Like you can see intraday, I'm talking, intraday, you can see the premiums are going up. See, this is 9:30 to this, the premiums are going up. It is not put, it is a combined chart of call and put, both call and put. Okay. So first thing is so first what I do is as soon as Bank Nifty opens, I create a view. My view is, for example, Bank Nifty is bullish. I load, okay. I load this. I see if this is going down. So for example, assume if I was here, if on this day, I would have like it would have. So what I want is this combined chart should hit a day low, which means the straddle or the combined chart should go down. As a seller, I want that, right? If this is going up, it's a loss for me. I want it to go down. Okay. So what I do is, again I'll explain. This is like little bit tricky also because it comes intuitive to me because I've been doing it for such a long time. So like I don't even know what I do sometimes. Like I just do it. So basically there are three things. First, first is like I show you a chart that if we create a delta neutral straddle only, you can do that also, but it's better to have some view. As I said, in options we get money of view and of view by having a view and having a view on volatility. Having a view on volatility is difficult, so that's why we are having a view on the market. So if my view is bullish, someone was why not buy a future only? See how market is 80% sideways, 20% trending, right? So 20% of the time I'll make a loss, but and 80% of the time I'll make profits. So what I do if my view is bullish, what people do, create a delta neutral triangle, sell a put at 200 and call at 200 premium. No. If my view is bullish, I'll sell a put, for example, 400 rupees, call at 200 rupees, which means I have to manage only if the trade goes against me, if the trade goes down, right? But if the stock is going in my favor, so till the time my delta is bullish, I won't adjust. At one point, if my delta becomes tries to become negative, I'll shift the puts up, right? And if you all don't want to do shifting, what you can do is shifting and all takes time and it like requires like you have to like be in front of the screen. If you do not want to shift, what you can do is you can keep a combined stop loss on the this only, because anyways you are creating a bullish view, right? So your stop loss will be hit if either there is a very wild movement on the upside or if the market moves downwards. But if the market is blowing up slowly, you won't lose any money. So you can keep a stop loss on the combined straddle also, combined strangle also. You can use VWAP for that. You can plot a VWAP on this, and the stop loss is above VWAP. How do you? Okay, so see this red line. So it is above VWAP. I won't take this trade only. I want it to be. So if I took this trade here, my stop loss was always VWAP. So I kept trailing using the VWAP. If it goes above VWAP, I'll exit. Right. So first thing is so whenever there's a directional move in the market, you'll always be out, because if it goes above VWAP, you'll exit. No matter, it can again come down. But VWAP I have observed in option VWAP and 20 moving average. So let's follow 5 minutes. Yeah. So see here on this day. Yeah. So on this day it was above VWAP, so you would have not created this triangle, no matter even if your view was bullish. See, as I said, option writers eat like a chicken but shit like an elephant. So we have to be a smart seller. Does not mean we'll come every day, sell strangles and go away. If it was so easy, everyone would have made money. That's where the discretion comes in. And let's put a 20 moving SM. So as per my observation, found out moving. How do I change? As per my observations on option charts, 20 moving average and VWAP is a good point to keep your stop losses. You see this, it is again bouncing on 20 SMA only, right? I assume you all to know VWAP. Everyone knows what VWAP is, right? It's volume weighted average price. Obviously, you can read online on it. It does not give a signal. See, if you look earning sheet, where was it? What have I written? What is this? All trades in direction of 20 DMA means daily moving average and VWAP. Why have I written this? Because I observed it's better to be with the VWAP on a smaller time frame. If stock is above VWAP, don't ever think of shorting it. If the stock is above VWAP, only look to buy. Is it clear? See why VWAP, why 20? Because I've observed it over time. So as I said, as a trader, you have to keep evolving, right? So this I already mentioned. You should have this. This is always there on my desk. See what I've written: risk management and contingency plan. Always know your max risk. No, I won't say it's linked to flow of smart money. Basically, it is the average price the market is being traded. So if someone wants to buy it, he will try to buy at that price. So there are a lot of things I see. The same mistakes. So as a trader, that is also important. If you keep doing the same mistake, it's bad. You have to do new mistakes every time, right? So focus on selected instruments only. Don't try to trade everything. I will trade Bank Nifty also. I'll trade all stocks also. No. Okay. So and you all can take the premium subscription. I think it's 600 rupees per month. I don't remember the price, but it is good if you're trading Bank Nifty with more than 20 lots, 10 lots. It is, I would say, it is worth the price. So again, I'll explain. Are you all able to understand? I don't know if people are able to understand also or no. Understand? All clear. Good. See, this is the VWAP is for Bank Nifty that day, or VWAP. This is the VWAP of the combined strangle. See, I am not trading Bank Nifty. I am trading the premiums, right? So it could have happened that Bank Nifty is going up. I don't know how many of you will trade markets. Sometimes it happens that the Bank Nifty is going up, but the puts don't decay at all, and the calls keep rising, right? So I am not trading Bank Nifty. I am trading the premium. So everything will be on the premium. When I take this trade, I don't look at Bank Nifty. I look at the premium. Sometimes it happens Bank Nifty moves in 500 points, but the premiums keep decaying, keep decaying. Right? So this is on what you are trading. I am trading the premiums. I am not trading the Bank Nifty. Right? I am using Bank Nifties to just have a view. Yeah. So combined premium VWAP, yes. So in this, it would already tell you, right? If it is above VWAP, you'll exit. So VWAP and 20 SMA is a good place to keep your stop loss, right? Again, coming to it, basically, if your view is bullish, you create a slightly skewed delta bullish position. What you do is you keep, so if you want to keep stop loss on the protection, if I want to keep a protection, okay. If I want to keep a protection, for example, in this example, 2900, 31,000, I'll keep a protection stop loss around 29,500 PE above its VWAP, above its 20 SMA, right? No, not for buying, not for buying. Buying, I'll discuss this other strategy. This is not a good strategy for buying. No, iChart is the only website which I think it's the best. Like I didn't find any other website, and it's the most affordable also. So again, is this example clear? Your view is bullish. I sell this put, I sell this call, but what is my risk if market goes against me? Okay, so let's keep a stop loss on the break even. Keep a stop loss above VWAP or 20 SMA. On the upside also keep a stop loss. If the trade goes in your favor, you don't have to do anything. If the trade comes, you hit the stop loss and exit. Is it clear? Okay, fine. Okay, one more flavor to this is when doing this, go to iCharts, check if the combined straddle is at day low and below VWAP. If yes, then only take the trade. Okay. Okay, so basically, why I'm trying to do this? I found out that even if Bank Nifty opens outside PDR, it is 80% of the time range bound. 20% of the time it moves violently. Okay, so let's create a bullish view. If I'm bullish, so I'll sell a put 300 premium. Market goes in my favor. I don't have to do anything. Automatically the decay will happen, and I will get benefit of time also, delta also. But I loss order on my protection on my wings. The stop loss will be above VWAP or 20 SMA in the individual chart. In the individual chart of 20,500 PE, right? As the trade goes in my favor, what I'll do is I'll keep shifting the puts up only if my view changes. Like if my view changes, for example, the premiums of the call increase too much, but the puts are not puts. The put, for example, the call premium is more than a put premium, then I'll keep shifting up. And by some time, by 11:30, you will get a 20-point decay, so you can exit at that time, or like you can like keep trailing, right? But one more thing is you will take the trade only if it's above VWAP and almost near the day low, the combined chart. Is it clear? Why stop loss at B strike? What is B strike? P. You mean P or B? What is it? Why stop loss? Think logically. Oh, is it? Somak, think logically. My loss will start below 29,500 put trade. Okay, let's skip this. Suppose you are not an intraday trader, right? You are not an intraday trader. You want to create a positional for overnight. So this is your trade. If you want to carry this position home, you know you will lose money below 29,200, right? So you will keep a stop loss below 29,200. What is this? Why is it not coming? See, 20,200 put was not showing only, so I kept 20,000. So if I keep at break even, my loss is capped, right? Somak, is it clear? I keep at break even because that's the point below which you will start losing money. Is it clear, Somak? Yeah. Okay. Thank you, Deepak. So yeah, so that's what you do. So for example, even if your stop loss gets hit, it's fine, right? Your loss is capped. You don't have to worry. But if you keep a stop loss on the straddle on the options, for example, 300 rupees, what people do is you have sold with a 300, you'll keep a stop loss 350. It will take your stop loss and you will be out. In this manner, you have time to adjust your trade. Suppose this gets executed. For example, this gets executed. What I can do is I can shift the call down, right? See, now the max loss is, in this case, is 12,000. What I'll do is, if my view, if the market is falling, what I can do is I can shift the calls down. I can bring this to 22,500. See, the loss comes to 9,500. I can keep doing this. The loss is 5,000 only. No, we are not creating an iron condor. See, if you create an iron condor for intraday, it does not make sense because the wings will lose money, but the strikes will give you money. So why to create an iron condor? If you have a view, create a straddle triangle, keep a stop loss on the wings, and we are keeping a stop loss on the wings because we have two options. Either keep option on the sold options, stop loss on the sold option. For example, if I sold, I can keep a stop loss at 400. I can keep a stop loss at 100 rupees at 200 rupees. But instead of keeping a stop loss on this, I'm keeping a stop loss on the wings because I can manage my trade. For example, even if the stop loss gets triggered, I still have a, suppose this gets triggered at 80 rupees. I still have 400 minus 80 rupees, 320 rupees credit, right? Which I can get. Are you able to understand or no? Like, is this getting clear, or I'll show more examples also. No, so my style is different. I don't close the losing leg. So for example, so that's why I create a view, right? So the benefit of creating a view is as soon as the market falls, I know I want to shift my calls down. So what I do is I'm already keeping a stop loss order, right? So what people do is they keep exiting the losing leg and keep shifting up. I don't do that. I keep shifting the winning leg up if the trade is going in my favor. And after a certain decay, I exit the trade. Okay, Jitin, I'll explain that. Jitin, are you able to understand like how these strikes came, the break-even strikes? So what, as I showed you in this, stop loss should be above VWAP or above the option premium. And these stop loss we keep just for protection. For example, bank nifty falls 1,000 point, at least your loss is capped, right? So in 29,500 P, whatever the price is above the VWAP or the 20 SMA, you will keep a buy stop loss. This is just a contingency plan. What if bank nifty falls 5,000 points in a minute? Bank nifty has flash crashed 1,500 points also in 2 minutes, right? Is it clear now, Jitin? Okay. So is it about this? That that if VWAP is, yeah, I'm not buying 29,500, 31,400. I'm not getting what I'm saying. Yeah, it is a buy stop loss. Yes, I'm not buying it. See, if I buy, then I won't get any DK only. I said I want credit. If I'm buying, I'm again giving that credit, right? So I just keep a stop loss. This is a stop loss in case the market falls or rises too much. See, I am creating a triangle. Even if the view is bullish, I want it to be bullish till a certain level. If bank nifty goes 1,000 points up, I lose money again. More complex one is putting stop loss for break even instead of positions open. Now it's okay. I didn't get the question. More complex one is putting stop loss for break even instead of positions open. Now it's okay. What does it mean? Yeah, Abhishek. So when will the premium go above 80? If the market falls, which means my view went wrong, right? I was bullish. So if your view goes wrong, definitely you lose money. Yes. I'm not keeping a stop loss on this. Why I'm not keeping stop loss is, see, I trade, for example, if I'm suppose trading 300 lots, I'm trading 300 lots, even suppose this puts get executed 400, again it comes to 380. So I lose on slippages, right? So why to keep the stop loss here? Rather keep the stop loss in this, right? My loss is all anyways capped. Sandeep, is it clear? Okay. Okay. So the method I discussed was with someone who is doing with a big capital. For example, see, like I trade like huge quantities in bank nifty, so I cannot. I do both the legs together. But if someone is doing only 2 lots, 5 lots, what they can do is for example, the same thing, if your view is bullish, right? For example, you get a previous day like high pattern, right? It breaks and sustain. You can sell a put. Suppose you sell a put at 300 rupees with a stop loss. If the put becomes 280, which means you earn 20 points profit, now sell the call. Instead of selling it together, once you have profit, then sell the call. Because what happens? Market goes in one direction and then becomes sideways. Right? This is second method, but this is to be done like if you're doing small quantity, less than 20 lots. If you're doing like more quantity, then like, because even a 21 stop loss on like 200, 300 lots is a bigger big, like big money. Right? So you can do this also. If you're doing small money, so what you can do is, so basically you sell a put naked. If you get some points, then you sell the call. No, I am in both. So basically, instead of creating the triangle at the same time, I get some profit and then you can sell the call. Okay. So the discretionary part is selling which strikes, which tool. So that comes, so that I do as per like which I feel the market will be below that level. So basically, you can see the max OI or like some percentage points above the previous day high or previous day low. So basically, that comes as per your view. But the goal is to, so basically, whenever you have a view, for example, it's a bullish view, create a slightly skewed bullish position. If you have smaller capital, sell the put initially, don't sell the call. You get some profits, then sell the call. Keep stop loss orders on the wings for in case if there's a very wild movement. Okay, if the market is going on the this, you keep trailing your stop loss, right? And yeah, and another thing is you look at the combined charts. The combined chart should be below VWAP and should be near day low. Abhishek, I'm not clear what you want to say. What is stop loss with VWAP? Stop loss above VWAP, I said. Everyone clear about the VWAP stop loss, right? Okay. And Jigar, are you finding this useful? You want, yeah. So, so yeah. So see, I have purposely kept it slightly discretionary because I once tried automating it, but the results with discretion are like much higher. But you know, like even the systematic part is I figured out when to create straddles, when to create strangles, right? So I'll again repeat for the one last time. So if my view is bullish, okay, what to do is you sell a put. If you are selling with a small capital, sell the put naked. Once you get a profit, then sell the call, right? Okay, if you're selling both together, whatever your break even is, load that strikes, keep a stop loss above the VWAP or 20 SMA of that individual strike. Okay, another point to look at is the combined premium should be below the VWAP and should be near to the day low. Okay, exit if loss is more than 20 points. Okay, and you can manage the trade as in if the market is going up, you can shift the puts up. If the market is falling down, you can shift the calls down. But that is very difficult to explain in a presentation. I think I'll share my trade logs and you have to like keep revisiting them to being able like to like then only you'll understand what happens. Clear? Like, is this clear? So I've written difficult to write, but I'll share my trade log. So whenever like I do it, I'll share. Okay. There is a risk if we sell P for bullish view and market suddenly reverse before selling the C for protection. What to do? First, keep the protection orders, then sell the options. I always put my stop loss orders, then I sell the options. Okay, now let's move forward. So same thing for a bearish view, like your view is bearish. So what I'll do is same thing. I'll sell a call with a higher premium and put with a lower premium as in delta. And I want the combined premium to be below VWAP and hitting day low, right? And I'll keep the stop loss on the break even strikes above VWAP. Why I'm not keeping stop loss on the sold strikes is to avoid slippages. What happens generally is initially I used to do that, but what happens, the 300 put when goes to 400, you're out of the trade, it again comes to 380. So you're trading huge quantity, the slippage is very high, right? The third is creating delta neutral. So what we do is we sell ATM CEP. This you can do. This you'll do. When will you do this? Yes. Yes, definitely. This is not an easy strategy. This is a very difficult strategy. Like not difficult, but see, all other strategies were simple buy or sell. In this strategy, the main skill is how you manage your trades. Yes. So we will sell when the opening is within previous day range, right? Sandeep, you were asking yesterday, okay, if the opening is within previous day range, we'll create this ATM straddle. In straddle, I keep a stop loss of 50 points, 40, 50 points, because I've observed that 40, 50 points is a good stop loss in the on the straddle. And what you can do is once you create a straddle, the market breaks day high or day low, and if it's sustaining, then you can then also exit the straddle at profit or loss. Sandeep, you are asking the same thing yesterday, right? So I have mentioned, right, market will chances of range bound, but breakout can happen anytime during the day. So if this is it, so we'll create a straddle, and if market breaks previous day low and sustaining, we will exit the straddle at profit or at loss. Is it clear? See, yeah, this is the only strategy which is discretionary in my entire, like, all my systems, and this is the strategy which, like, I trade day in and day out, like every day I do it. Yeah. So when to do, when not to do. So first of all, someone who does not have much experience with options, don't sell only, don't do these triangles if this condition is there. Do straddles only if the market is opening within previous day range. If you have less experience with options, only create strangles if market is opening within previous day range. Okay. If you feel the market is bullish, buy options with a stop loss. If you think market is bearish, buy options, buy put options with a stop loss or create spreads. And only in this scenario, sell options. Can we add one more short put to straddle when the market comes to? What if the market reverses from the day high? Then what will you do? Wait, guys. Market can reverse also from day high, right? And most of the time it does that only. Sandeep, is it clear? If market is in previous day range, I think straddle is better than strangle. Yes, definitely. That's why I've kept it discretionary now, because see, I have kept discretionary because see, I want to capture time, I want to capture delta. But if I create an algo around it, what we will do? It will either create shadows or either will create angles and keep managing and take a trade, exit at a stop loss. But you see, there's so much dynamics involved in this. So that's what helps me. And like as I observe Bank Nifty, like I know like how to create a view, what to do, what not to do. Abhishek, is it clear? So I purposely kept it discretionary. Like I would say it's 20-30% discretionary, but the underlying of doing that was I observed these charts. Then I figured out, okay, even if the market is opening, I can create. And due to my understanding of Bank Nifty, I like try to do it. If you want to do, what you can do is, if you want to 100% automate it, directly create a straddle with a stop loss. That's it. So create a straddle only when this happens. Other days, don't do strangles. You do directional trades, right? Again, I'll repeat. First is, this chart shows that if market is within the range, market is mostly sideways, but breakout can happen anytime during the day. Okay, so this is one starting point which says that, okay, if market is opening within previous day range, market is mostly sideways. Market opens outside previous day, it is 80% sideways, but there are big direction moves also. So if you're a new player, market opening outside PDR, don't do straddle triangles, do the trades like we discussed yesterday. Directional trade, buy with stop loss. Okay, so if the market is bullish, for example, if it's breaking day high, and if you're a new player, directly buy options or directly sell put option with stop loss. Don't do strangle. Same with slight bearish buys also. And only time you should do is when it is between the previous day range. But if someone has experience, can manage the trade, I think Jigger can do, or like a lot of people can do. You can sell both sides and manage the trades. Anyways, the loss is capped. Plus, you have put stop loss protection orders. You are taking another view, that another confirmation that the combined premium should be below VWAP and near day low. Is it clear? See, someone who has less than 10 lakhs capital, don't even do strangles when the market is opening outside previous day range. If it's opening within the range, then only do. Is it clear? Is anyone who's finding it difficult, like not able to understand? Sandeep, because I'm not adjusting only, right? I don't want to adjust only. If the market is within previous day, I don't want to adjust. I'll create a straddle and exit with stop loss. You can see this equity curve, right? That's why straddle. Yeah. Practice is important, and this is a strategy which is more suitable for someone with a bigger capital, not suitable for someone who has a small capital, 5 lakh, even less than 10 lakhs. I won't say to do this strategy, because this is a risky strategy. It's, if you cannot manage the trade, you can lose a lot of money, and doing in Bank Nifty with a small capital is suicidal. See, Bank Nifty is one of the most volatile instruments to trade, and you like have to be on your toes if you're trading Bank Nifty. So if you are a new option trader, don't do strangles. You have a lot of other systems to trade. Only do this when the market is within previous day range. How to manage BNF? How to manage strangle when BNF is V-shaped during the day? BNF is V-shaped during the, so if it's V-shaped, your stop loss will get triggered if the market is one side, and so that's where the view, having a view part comes into play, right? So if it is moving on both sides, it could have happened. It could trigger both stop losses. So that day you have to take a loss. So that day, so you cannot make profit every day. But see, with experience, you like with experience, you understand how to trade the markets. That's why I'm saying, if you are having a directional view, and if you don't have much experience with adjustments and option selling, take a directional view only. Create a spread, buy naked with stop loss, right? Nitesh Patel, like he does directional trading, or he sells naked. See, if we try to cover each and every scenario, that will lead to curve fitting. We cannot optimize the system for all market conditions. Every system will have some days where it will, when it will lose. So if you try to optimize for every condition, okay, I'll optimize for this, I'll optimize for this. Eventually, it will lead to curve fitting, and basically you won't make any money. That's why I'm saying, if you have a small capital, don't do strangles only. Strangles, rest systems you can do, right? It's simple. Buy with stop loss. You don't have to apply your brains also. In this, you have to apply. You have to manage. You have to be in front of the screen. Is it clear? See, we cannot optimize for all scenarios. Yeah, something called as curve fitting. So we will end up doing that. Okay, so I think this is like slightly like difficult also, even I agree. So I'll keep sharing my trade logs. You'll have to go through it and you have to see what I did, how I did. You have to figure out on your own. But the basic concept is simple. And if someone is finding it complicated, don't do this. Only do this simple thing. When the market is opening within previous, create a straddle with stop loss. That's it. Don't do anything else. Clear? Oh, nice. Yeah, this is interesting, definitely, and it is lucrative also. I do it day in and day out. I have been doing this for last 4 years. But I would say the main edge in this is understanding how Bank Nifty moves. So there are certain things which I cannot write on paper, but I've seen Bank Nifty for so many years. So intuitively it comes to me, okay, how will the Bank Nifty move? And accordingly, I take my trade. Sometimes I take a risk. Sometimes I cut on one leg and be in the trade. So this is the only thing which is slightly discretionary, and I purposely kept it discretionary because if it's without discretion, you cannot make like. So the edge comes is in having the understanding of Bank Nifty, right? So that is the edge. So see, as a system trader, certain like as a system does not mean that if you trade systems you'll always make money. Having discretion is also very important, but you should most systems should be automated or should be systematic, but few systems should have discretion, should have your understanding about the market, and that with what will separate you from others. If everything is automated, which means everyone can come and make money, but in this case it depends on you, how you understand the market, how you form a view, how you manage your trades, and that will only come with experience and observing the markets. Observe the markets day in day out, 9 to 3:30. Take screenshot, how did the market move, what happened, what you should have done. So with time you'll understand. So I've already noted the learnings, I'll share that with you, but this will come with experience. Is it clear? Yeah, if someone is finding it difficult, and I won't recommend this to for new traders also, skip this strategy. Just do this third part, rest you can skip. Clear? So and how I came up with this is like what I figured out here. Okay, if the market was bullish initially, what I used to do, I used to sell naked put or buy call. But then I figured out market, even if the market is bullish, it is not going up. It is going up very slowly. So I thought, why not sell a create a skewed view and then manage the trade. So that's how I came up with this. So instead of, so that's why I try to trade Bank Nifty every day in similar manner. Only day not to do this is whenever the market opens with a gap. Whenever there's a big gap opening, avoid trading this. Avoid creating strangles if the market opens with a gap. I mentioned in the learnings also. So when to avoid is whenever there is a gap, big gap opening. How much return? See, return depends on how much leverage you get. So returns like on certain days you can even make 2-3%, such as Thursday, Wednesday, you can make. But see, that comes with leverage. Like you take 5x leverage, 6x leverage. So basically, on an average, you can capture 20 points in Bank Nifty. So now the returns depend on how much quantity you trade. So 20 points on a 1x leverage, for example, 2 lakhs you are making. So if you assume 100% margin, average it is 2 lakhs for one straddle. But most brokers give leverage. More than 0.5%, I would say gap is more than 0.5% gap. Don't do straddles. Try to do directional trading. See, average you can capture 20 points, and it's also there in this. Like this is a straddle, that's why it's showing 57 points. But if you see the number of trades are almost 800, the points captured is 17,000. So it's almost 20 points we get in this also, like almost 20 points on an average we get, but we can generate more also if you know how to manage the trade and all such things. But average 20 points. So if someone is doing with a lesser capital, it won't even make sense, because if you're doing 2-3 lots, the brokerage will be also high, because basically 20 points on one lot is 400 rupees. If you're doing 2 lots, you'll make 800 points, 800 rupees, and you'll do adjustment. So you'll give up 200 in brokerage. So it does not make sense. If you're doing large capital and your brokerage is flat, then it makes sense. So basically, this is one system which you can avoid if you like. If you are not good with trading and like managing the trades, just do this. Okay, this is clear. Then I'll move forward. How many of you all like have traded Bank Nifty, have understanding with options adjustment, or like are doing something similar? Traded BNFNN. Okay. Others? No. Sandeep, no. See, don't confuse so many things. Just focus on one simple thing's price. OI only I said we look in the last half of the expiry. Usually scalp with option buying. Okay, Jigar. Okay, Jigar, are you finding this useful? Like, did you learn something new? Okay, scalp. Okay. So yeah, you, instead of doing straddle, you can do this. So this will give better returns. And you can combine the charts and see if it's below VWAP and hitting day low. Yeah, so we're doing straddle daily. This is like slightly better than straddle because you can have a view also, plus you can manage your trades also, plus you're combining the charts and trading the premiums. You can see that in iChart. Yes. Okay, so now let's move forward. This what I'll do is, so we'll anyways create a WhatsApp group. Whenever there, whenever I do these kind of trades, I'll, is this delta neutral and week? No, weekly expiry is different. So this is weekly expiry. I'll explain, the concept is similar only. Yeah. So yeah, so this is the only system which is slightly discretionary. But the third part is can be completely automated. So only the A and B part are discretionary. Okay, so you all can focus on the third part, C part. Okay, so why will you do if you have strangle as on EOD Friday? What will you do if you have strangle as on? I didn't get your question. Like, what will I do if you have strangle as on EOD Friday? Which means you means I carried this position home. I'll exit at a loss. 600 points gap down. I'll exit. See, if a strikes become in the money, there's no point holding on to that strike. Till my strikes is out of the money, I can do management. When it becomes in the money, I'll exit the trade at a loss. No. Overnight, what you can do? That's why I said overnight everything should be hedged. Overnight everything should be hedged. Overnight before, like I don't know if you read my blog. Before going home, I check what will happen if market hits lower circuit or market hits upper circuit, and it can happen, right? Is it better to make delta neutral triangle than when? But Abhishek, both are fine. You can, like I would say straddle is much better because in strangle again, like you, because straddle is better, I would say. Okay, so let's move forward. I think what I'll do is I'll create a WhatsApp group. Whenever I do such kind of trades, I'll share the entire trade log with timestamp. You have to figure out on your own. But this is risky. So if you are new trader, please don't try this. Just do the C part. Don't do the A and B. No, it is different. It is different. the concept is same, but it is different and it is even more complex than this. So that also, if you're a new trader, avoid. See, every system should meet your psychology. Does not mean that if everyone is doing expiry trading, I'll also do expiry. Expiry trading is risky also. You need to be very good with options management. Okay, so now let's move forward. So I'll discuss one more strategy in Bank Nifty. Anyone wants any break? 5-10 minutes, or we'll take a break at 1 then. Okay. Okay, so we discussed Bank Nifty. How did we build a strategy and what to do, what not to do. A and B is slightly discretionary. C is fully systematic. So A and B requires adjustments also. So if you are not good at it, avoid it. So now let's move on to another strategy, which is the Wednesday positional strategy in BNF. Okay, so I'll show you. Just a second. Okay. Everyone can see the Jupyter notebook, right? This screen, everyone can see, right? Yeah. So I'll explain the strategy. So before explaining the strategy, let me show you. So I tested this for. See, I tested this in 2019. So like 4 months ago, 5 months ago. So till that time, there were total 180 expiries. So this is week name 180 expiries. Out of 180 expiries, this is the number of times the stop loss was hit. 3, 6, 7, 8, 9. So only 9 times the stop loss was hit out of 180 expiries. That is the accuracy of 95%. Right. So this we tested like now you can again test it, but for the last year I think the stop loss was not hit even once. So the accuracy is still around 95% only. Okay. So what the strategy is? Let me open strategy. Wait a second. Wait a second, guys. Yeah. Okay. So in this strategy, this is basically you create the strategy on Wednesday close around 3:15 and exit at on Thursday morning. So this is basically overnight strategy. Overnight we can make 0.2% of capital, 0.2 to 0.4. So return is not great, but for 1 day, 0.2% is also good, right? If you have idle capital lying. Okay, so there are two things in the strategy. First is mode. So how to find out a mode? So what a mode is? So basically, if close, listen to this carefully, if close is greater than previous day high, then the mode is in a rally mode. If close is less than previous day low, it is a decline mode. And it will change from one mode to another only if the opposite condition is true. So if you can see here, what I am written here, rally mode if close greater than previous day high, don't see the or condition. If close greater than previous day high, it's a rally mode. So in this, let me ask you, what is this mode where my cursor is? Is this a rally mode or a decline mode? Rally, right? Okay. What is this mode? Is the close greater than previous day high? Then how is it rally? No, it's not decline. So then that's where we come to the second condition. If close is greater than previous day, it's a rally mode, or close greater than previous day low. So which means once a day is in a rally mode, it will change to decline mode only if it closes below previous day low. Is it making sense? Yes, Avi, right. So if close greater than previous day high, it is rally mode. It will change to decline mode only if close is less than previous day. That's why the condition has been written if close greater than previous day high, rally, or the close greater than previous day low. So this is rally mode, right? Because close is greater than previous day low. Till now, is it clear? So basically, close greater than previous day high, rally mode. The mode will continue till the time it closes below previous day low. Okay, so now let's look at the other condition. If close less than previous day low, it is decline mode, right? So if close is less than previous day mode, for example, this is what is this mode? This is a decline mode, right? Yeah. So if close is less than previous day mode, it is a decline mode. It will continue into decline mode. It will change to rally mode only if close is greater than previous day high, right? Yeah. So so now this is clear. So so basically the purpose of this strategy is, so what I found out is basically on Wednesday I want to sell options which will expire worthless the next day, right? So if I know the mode, so let basically what the strategy mode is, then Wednesday low minus 200 points have chances to expire worthless, high chances. If mode is decline, then if Wednesday basically is one day before expiry. If Wednesday is holiday, it could be Tuesday also. If mode is decline, then Wednesday high plus 200 points have high chances to become expire worthless on Thursday. Is what is it's written? Is it clear what I've written here? So basically, what this is saying, if the mode is rally on Wednesday, so you will checking the mode on Wednesday, right? Because we are doing a trade on Wednesday. If the mode is rally on Wednesday, which means that Wednesday low minus 200 points expires worthless on Thursday expiry. If it's decline, then Wednesday high plus 200 points. I have given a 200 point buffer that will expire worthless on Thursday. Is this clear till now? Yeah. Okay. So what you can do is on Wednesday closing time, you can check the mode. Simple, right? This strategy has to be done only on Wednesday. Wednesday means one day before expiry. So you can check the mode. If the mode is rally, if the mode, what will you do? See what I said, theta decay curve happens maximum closer to expiry, which means the Wednesday overnight decay will be the maximum. Most people do is they sell both call and put. But if you sell both call and put, basically if there's a big movement, you will lose. So why not sell only one put or call as per the mode? Is it clear what I just said? Yeah. So on Wednesday, the logic is clear, right? Wednesday overnight, there is a maximum theta decay, which happens overnight only. Last week, overnight, there was 120 points decay in strangles. So 200 point strangle opened at 80 rupees. So nowadays, the decay happens Wednesday overnight. How do I build a strategy around it? I don't want to sell naked call and put both sides, because if I sell both, then if there's a big movement, I lose. So why not try to figure out a way in which I can get some sense of direction, like whether to sell call or put. So okay, let's try to find out mode. Okay, if mode is rally, what will you do? Yeah, Wednesday EOD, Wednesday 315. So if mode is rally, what will you do? You will sell call or put. Put which put? But which put will you sell? 200 point away. From where 200 point away? Yes, low minus 200. But low minus 200, will you get any premium? Not close, low. Not close. Abhishek, not close. Yeah, low minus 200. But low minus 200, you get only like very less premium, 5 rupees, 10 rupees, right? Right, the premiums are lesser, right? And if we carry this naked, so we are, as I said, eat like a chicken, shit like an elephant. We can make only 10 points, but the option can open even at 1,000 rupees, right? So then I said, this does not make sense. Why to sell naked? So instead of selling an option for 20 rupees, assume, I'm just giving hypothetical, low is high, low, high is 30,000, low is 29,500. You have one option to sell 29,300 fee at 20 rupees. Is it clear? But if there's a big gap down opening, you will lose a lot of money. So why not sell 29,500 and buy 29,300? So you sell, for example, approx at around 50 rupees, and you suppose you sell at 40 rupees and you buy at 20 rupees. Still net credit is 20 rupees. But your loss is at least capped. No, the loss is big if you go wrong, but if it's capped, right? Is it making sense? Why did I do this? Yeah. Okay. So the dynamics still remain the same, but I'm at least not losing a lot of money if I go wrong. And even if the next day market opens against you, we'll understand how to manage this using the expiry date. Because anyways, on Thursday we will be doing expiry trading, right? The only time we will lose money is if the opening is only below our level, our sold option level. That's the only time we'll lose money. Even if the market opens at 29,700, the closing was, for example, 30,000, it opens 300 points gap down, it's fine. 300 points down, it's fine. We'll lose money only if the opening is outside the range. That day we cannot do, we can wait till close also, because anyways the loss is capped. According to spot, it's fine. You can, both are similar, but yeah, spot, because the you have to check the spot. Yeah. So so is this clear why the strategy was built and how it was built? So you have to think in this manner. Then only see after 1 2 months, 5 months from now, I could be trading a different strategy only. So you have to keep thinking in this manner to come up with your strategy, come up with your observations. So the observation was Wednesday is the highest decay. What to do? I thought okay, sell both call and put. No, but I am losing money in that. Is there a way I can try to capture on the direction? Okay, sell it naked, but naked I was, if it's a big gap down I lost money. Okay, now try to create a hedge. Okay, this is working fine, right? You have to think in these terms when you build a strategy. Okay, so this is simple, this is clear, right? And the same on the opposite side, if it's in decline you sell high plus 200, and instead of selling high plus 200 you sell the high and buy the protection, right? So and so only time you will lose money is if the opening is below the sold strikes. If it does not open below the sold strike, you can manage as we do the expiry trading that we will discuss, because anyway on Thursday we do expiry trading, right? See, even if market opens at 29,600 and it will become zero, right? You will get the 20 point. Yeah. No, if no, no, you once you square off it all together. See, anyways, 20 rupees option will be open at 5 rupees. Why to like exit the boat at opening together only? Don't keep naked. Okay, so this in this Excel sheet I've already mentioned the formulas. I'll share it with you, but I don't think you don't need it. Also, you can by yourself also do it. Like one day you just have to check these conditions. Okay. But see, again, this strategy is also suitable for someone having very big capital. See, if you're doing one lot, you will make 15 points. That is 300 rupees only. But if you are doing, for example, 20 lots, then it makes sense also. So basically, but this, why do I do is, we'll discuss this in money management. And anyways, Wednesday, my money is lying idle, right? Why not get some point? For example, if by carrying this trade, I get a morning, for example, 20,000 rupees. So now I have that 20,000 rupees cushion to take risk for that day. So what I do is I'll do naked trades and keep a stop loss of 20,000. Well, anyways, if the 20,000 loss, okay, I'm at zero, right? But if I go right, I can make 40,000, right? This gives you a cushion on expiry day, and this strategy, as I said, the accuracy is also good. But the only thing is, accuracy is good, but uh, on Thursday you can manage the trade also using as we do expiry trading that we will discuss. Is the system clear? What we are doing, how we are doing? Is this also clear? Or what not? This part, like, you don't have to see the code, but how the strategy was built. It's clear. Then we'll move forward. I'll again just repeat what I just said. So basically, not. Can we see the violin plot for this one? So it's a violin plot of Bank Nifty only, right? So now basically the strategy is on Wednesday. Wednesday means one day before expiry. Wednesday is a holiday. Tuesday will be the one day before expiry. Find out the mode. Mode is simple. If close is greater than previous day high, the mode is rally, and the mode will continue till the close is below PDL, and vice versa for decline mode. Once you know the mode, sell whatever. If the mode is rally, sell the low put and buy a protection such that you get a credit of 20 points. Same on the opposite side, right? And in the morning next day we will do expiry trading. So we can keep this position open. I'll explain how do we do expiry trading. Is this clear till now? So the returns are, I would say, 0.2% overnight. So 0.2% is not bad. If you see a month, you are getting, for 4 days you are getting almost 0.8%, which is not bad, right? Yeah, so let's stop the screen share now. Okay, so same thing. Can we do back testing in Sensible? I have not checked Sensible. I would say like do it yourself in Python only. You have to do it yourself only. I think Sensible does not provide back testing. I guess I have not checked, but I don't think so. And see, no one will provide you custom back test. Find like, okay, you write the mode and every. They'll only provide you general back test. For all such back tests, you have to do it on your own only. You have to write your own Python code. You have to do it manually. Yeah, you can replace Sensible, Obstra with Sensible. Obstra is free also. But back testing and all, I think you have to do it on your own only. Yes, these instruments, these principles are common. So if you see, I generally try to build my strategies across timeless concepts. So why I do majority of the time theta decay, because theta decay is one thing which the edge will never go. No matter I will make lesser return, but decay has to happen, right? But as I said, the movement of S&P. So where will your edge come is you understanding how the S&P moves. My edge comes from understanding how the Bank Nifty moves. So your edge will come from understanding how the S&P moves. But these are timeless concepts. So people ask you, why do you even teach if you like trade or like you're a successful trader? See, I like to teach. That's why I don't. First of all, I don't share my detailed backtest report. So certain edge I still have with me. But I give you like almost 95% of the thing I've already told you what to do, what not to do. But these are timeless concepts. So option theta decay strategies won't go like you instead of making 20 points, I'll make 15 points. But the decay is bound to happen, right? So that's why the concepts can be applied anywhere, but it depends how you can like refine your edge by understanding the instrument better or certain things, right? And my major edge I would say is in managing the trade. If I take a trade, I told you like how do I edge it? I sell a call, I manage it. So that's where the edge comes from. Yeah, I did only for Bank Nifty because see for Nifty there's data only for last 1 year. There are only 50 trades, right? Am I audible? Yeah, okay. Sorry, I got disconnected. Someone was asking something. Please. How much does the option data and future data cost in general? So, for last 4 years of historical data, it would cost you around 1.5 lakhs. But even in that, you need to do a lot of data cleaning. Abhishek. Yeah. So EOD data is free. EOD data you can get from the NSE Bhav copy only. Any positional strategy for long call put, it will have. Yes, yes, we'll discuss that. Sandeep. Yeah, Abhishek. The data is costly, definitely. The FNO data is costly. That's why, like, but if you are like, so like we for us it's like we do a lot of testing, so that's why we take the data. But yeah, if someone doing it individually, that is definitely expensive. So I would say like what you can do is you can like you most of the strategy you can test on the EOD data that you can do. For intraday data, like generally the bank nifty thing is which is more on the intraday data. And the spot data also you can get. Spot data if you want, we can give you. Options data we cannot share because spot data we have stored ourselves, so we can give that. Options data we cannot give because like uh, there will be issues if we do that. Okay, anyone wants spot data, we can give minute by minute. Okay, Abhishek. Yeah. Yeah, so data is expensive, but it's fine. Like you don't have to like worry about that. You can do it manually also, going to the charts one by one, and then try to see how the strategy is doing or not. Okay. Okay. So I think till now it's clear. Then we'll move forward. Yeah, Sandeep, I'll come to it. Strategy with long call, long put. See, I am mostly a seller only. There are only few times when I buy options. I don't know, like I don't have the buying temperament. Buying is lucrative. We are actually trying to use machine learning to create a scalping strategy. So let's see if it's like if we are successful in that. But generally, I don't like to buy. There are certain instances when I buy, I'll explain when to do that. Okay. See, buying is a different skill set altogether. I would say it is more difficult than selling because you need to be right on the direction, timing, everything should be perfect. Okay, so let's move forward. My screen is visible, right? Screen is visible, right? Okay. So again, coming to a strategy called expiry trading. Again, it is a strategy in which we are actually fighting gamma. So there are certain risks involved in expiry trading. But if done properly, this is a very like it gives you good returns, but you need leverage for it. So just let's have so basically it is so basically the concept of expiry trading is on Thursday, options which are expiring worthless will become zero. Okay, so basically we have to figure out which options to sell that will expire zero. So let's see how it's done. So first of all, as soon as the market opens, I try what does the market look to me? Is it trending or range? So if it's opening within previous day range, then it's fine. But if it's opening outside previous day range, I see okay. What is the downside bank nifty can go? What is the upside bank nifty can go? Okay. For that, you can see the max call OI, max put OI also, right? I've written look at max call OI, max put OI. And I'm inclined towards the Wednesday mode. Inclined to the Wednesday mode. For example, Wednesday was rally mode. And for example, intraday bank nifty is falling. I'll try to sell puts. I'll explain how to do the strategy, but just see. Then what is done is you manage the deltas during the day as per your use. Because you keep managing the trade and eventually by 2:30 options which are like far OTM will decay. the risk in this strategy is the gamma risk, and this is the riskiest strategy out of all. The gamma risk is you if you trade expiry, 2 rupee option becomes 50 rupees in 1 minute, again come back to 2 rupees. That's a gamma risk. So you can mitigate gamma risk by exiting all your trades by 2:30. Other risk is option freeze. Like sometimes option gets freeze. Like for example, a 20 rupees option will directly open at 150 rupees. So to mitigate that risk, you have to keep protection orders, buy protection orders on far OTM options. Now I'll explain the strategy, what to do, how to do. So basically, the goal of expiry trading is to figure out options which will expire worthless. Worthless, okay. So what I do is as soon as the market opens, I try to gauge what the market is doing. Okay, if I think the market is trending, I'll create bullish. I'll sell more puts, like put with higher premium, call with small premiums. If the market is ranging, I figure out the range and I try to sell those triangles. I'm more inclined towards the Wednesday mode. For example, if the Wednesday mode is rally, which means as per my Wednesday strategy, the Wednesday low or minus 200 points will expire worthless. So if the market is falling, I try to sell options around those levels. And I look at the max call OI and max put OI to see what the market players believe the range is. You have to manage your deltas during the day. You exit by 2:30 p.m. These two are the risks. Okay, so now let's show you an. Is this clear? Then I'll move to the example. So, okay, so basically this is similar to what we did in the basically what we do in intraday bank nifty. It's similar, but in this case the decay is faster and the gamma risk is higher. So basically you do the same thing. As soon as the market opens, you try to figure out what the range is. Okay, you, for example, in this case market opened above the high and I feel the market is bullish, so I would say okay, below previous day high market won't close, like this is my range. And on the call side I will see what is the max OI. I feel that will be the range. That is my view. Okay, as soon as the market opens, if the market is opening within previous day range, I would say previous day high, previous day low should be the range. And I'll also look at OI data. I don't give much importance to OI data, but I just have a view what is happening on the OI data, like what the market participants believe the range is, right? Okay, so basically our goal is to sell both call and put, and our expectation is both will expire worthless. But the difference in expiry trading is, see, on normal days you directly create a trade, right? But on expiry day, because the decay is going to happen today, you start with 1/10 of your position size. For example, let me suppose example you can do 100 lots for the day, 100 lots put, 100 lot call, for example. Okay, just hypothetical example. This is what you can do. So this is your maximum quantity you can do on your capital. So you won't sell 100 at morning only because you want to capture decay, right? So what you will do is you will sell 10 lot put, 10 lot call. Basically, lots CAP assume 30,000 and you feel 29,500 and 3,500. Okay. Is my voice clear? Hello? Okay, wait. Just give me 1 second. Is the voice clear now? It's clear, right? Okay, fine. Okay. So the concept of expiry trading is that uh, you want to figure out which options will expire worthless. So as you on the markets, as per the OI data and as per Wednesday mode, you figure out strikes which will expire worthless. So for example, in this case, I assume 29,500 and 30,500 will expire worthless. But I want all the quantity together. I'll sell 10 lots at each time. Like 1/10 of my total quantity I can do. So I sell 10 lots. And suppose as Bank Nifty goes up, I'll keep shifting the puts up. Bank Nifty goes down, I'll keep shifting the calls down. As we discussed in the intraday thing. But we keep doing this the entire day till our maximum position is reached because the decay happens slowly till 2:30. Right? And I don't like to sell premiums with small premiums with 5-10 rupees. I like to sell premiums which are like slightly bigger. So for example, you're selling this at 40 rupees, you're selling this also at 40 rupees. So initially what you can do is you can keep a stop loss at 2.5 times of the sold option. You can keep a stop loss of, for example, this into 2.5. This is on the initial stop loss. So 100 you can keep on both legs, but you have only built 10 lots only. With as market, so with time you'll keep adding your position and you'll keep adjusting your view. For example, you'll sell 29,600. If the market is going up, you'll sell. You'll keep shifting the puts. Basically, you want the premiums to be same in a simple manner. If your view, like if you want to, like if your view is sideways, if your view is bullish, you want the put premiums to be more than the call premium. So for example, if I'm bullish, I'll put premium at 80 rupees and call it. My view goes right, this will become sideways and the decay is very fast on the expiry day. Right? So basically the concept is very simple, the concept, but this is like little difficult to actually trade in the market. Like this is also, as I said, like you need to have the option skills to manage your trade. So basically overview is whatever your view is, as per that you create your positions, but you don't go all in, you create slowly in tranches of 1/10. As the trade goes in your favor, you keep shifting your puts up. For example, if the trade, your view is bullish, you create a bullish position, market is going up, okay, your view is going right, you'll keep shifting the puts up also. uh, and on the same side, if your view is sideways, you will same premium. But for example, this is 40 rupees, so you'll exit this 40 and again sell option which is 50 rupees sideways. This is sideways, and on expiry day the trades, I do more than even 300 trades. So like it's completely like dynamic, and you have to be in front of a screen. And if you're bearish, you do the opposite thing. You sell a call of 80, put of call of 80, put of 40 rupees. And as the market falls down, you keep rolling your strikes. But you keep doing this the entire day. That's why you start with 110, and you keep doing it entire day because the decay happens gradually over the day. And after one at 2:30, you'll exit the trade. And same thing, you can visit iCharts. You can visit iCharts of the strike which you are selling. You can see whether it's below VWAP or not. Is it hitting day low or no? If it is, it gives you more conviction. Yeah, I start from 9:30 and I do it till 2. But as I said, yeah, I start from 9:30, do it the entire day. That's why I said I do it in 1/10 of my total quantity. Right? And the decay is maximum on Thursday. So basically, this is similar to what we are doing on Bank Nifty if you are managing strangles. But on these days, the decay is faster, but the risk is the gamma risk is also very high. So that's why you always keep stop loss in your system. When you decide to sell P, C as triangle or resistance support, what kind of premium value you write in shadow? So it depends. Like there's no number to it because like every expiry, the premiums are completely different. See, it depends on the current volatility also in the market. So the premiums are different. But generally, I like to sell options which are at least 30 rupees, minimum 30 rupees. And I'm at least 2 strikes away from the spot price. On some day premium are low. So yeah, if the premiums are very low and I think I'm not getting so these days the premiums are very low. So these days I'm doing a very small quantity. I said I exited 230, Abhishek. Yeah. So see, for example, assume Bank Nifty the 30,000, right? Straddle is quoting, for example, at 150 points. Creating a straddle makes sense because 150 points is basically only 0.5% of the movement. And Bank Nifty 1.5% is very normal, right? So if I'm not compensated enough, I won't do this trade. 450 points, which means it's a good premium and I can manage it. No, I am selling both call and put. I'm not selling a naked option. I'm selling both. So basically, as I said, right, in the similar to what we discussed in the intraday Bank Nifty thing, it's exactly similar to that only. But adjustments are very fast and you build slowly your position slowly. So if your view is bullish, sell a put of a higher premium, call of a lower premium, which strikes to select, you can look at the OI data. And as the market moves in your favor, you keep adding to your positions, right? And if, same on the bearish side. And if the market is sideways, you can create the previous day high, previous day low put, you can sell and manage your trade. And if the good premiums are good at the straddle, you can do the straddle also. Is it clear? Like there is no, like, I would say, simple method to explain this. Like you have to do it, like you have to actually do it to understand it. But the concept is very simple. You start with 110 quantity. As soon as the trade goes in your favor, you keep adding to your positions and you do this the entire day. But the important thing is having a view and figuring out which strikes will expire worthless. That you can, I add the position slowly because if I add at the start, if I go wrong, I can lose big, right? If I take the position in the decay is anyways not instant, right? So why not let the market prove me right and then I'll add to my positions. Well, anyways, my goal is to capture the decay, right? Yeah, there is no thumb rule to it. And I tried automating expiry also. It's like the results are not good. So basically, the main skill in this is only the management of the trades. Yeah, handling reversal is very difficult. That's why you always keep a stop loss of 1 or 2% of capital. On expiry day, if you don't follow that, you can even lose 20% of a capital if you're trading with leverage. So this is a risky strategy. And now a lot of people have jumped into it. Earlier, like very few people used to do it. So the movements were also very smooth. Now a lot of people are jumping into it. So it's getting little complex also. And like your skill has to also increase if you want to trade this. But the concept is simple. Do start slowly, have a view, start slowly, create your and create your position accordingly and keep adjusting it and build onto your position slowly. By 230, get out of all the trades because the gamma risk is very high after 230. And yeah, so that is it. I think there's nothing much to explain. What I'll do on Thursday, I'll sell, share my trade log also. But yeah, as I said, like on Thursday, trades can go up to even 300 trades a day, sometimes even 400. So yeah, there's no thumb rule to it. So the intraday Bank Nifty thing, it's very difficult. Like it is more on experience rather than like a system. So, but what you can use is so as I said, you can use the things you know. On the basis of open, you can try to gauge the movement of bank nifty. If day high is broken, you try to take a bullish view. If day low is broken, you try to take a bearish view. And I always try to be away from the spot, at least 2 or 3 strikes away. Add to your position slowly. Manage your deltas the entire day, and always keep a stop loss of on 2% of your capital, because if a wild move comes, because the gamma can hurt you very badly. Is it clear? Like, because there's nothing much to explain in this. It's similar to what I explained in Bank Nifty only. This is, I would say, the riskiest of all the strategies. It's very risky, and like if you have not traded markets for at least 2 years, don't even do this strategy. But the concept is similar to what we do on other days. Only thing is the pay, like the return is also high on this day. The risk is also little high on this day. Is it clear? See, new traders don't do expiry trading. It's fine. Like, you can avoid expiry trading. Yeah, Friday I do a less position sizing. Wednesday and Thursday I like to capture, like the DK is very high. Not bad, but Friday I do a small position sizing. In Friday I generally try to pay directional also. Push, there is no set rule for that. Like there's no rule, like there's no fixed rule for that. Like what, because premium depends on the IVs of the bank nifty. So there is no set rule of that. But what you can do is you can see the movement of bank nifty for last 5 days and see if you are getting compensated. The premium is at least, the straddle premium should be at least the average of the last 5 days, 5 days range. So there's, see, if the premiums are higher, which means the movement will also be higher. If the premiums are lesser, the movement will also be lesser. So there's no set rule like how much should be the premium. But if the premium is less than what the range for bank nifty is, for example, the range for bank nifty every day is 400 points, and you're getting a 150 point only on the straddle, which means it's not good to sell options straddle, because the movement is 400 points, but you're getting only 150. Is it clear? Push. Yeah. So there are no set rules for this. So again, I'll say what I just said. So first of all, you already know 4 patterns, right? If those 4 patterns are not there, market will open within the range. So you know 5 things. Out of that, you can try to figure out a view. Okay, once you have a view, you have to figure out which strikes to sell. Be inclined towards the Wednesday mode. If Wednesday mode is rally, which means selling those puts may expire worthless. So first you figure out what is the market, if it's trending or ranging. If any 4 of the patterns is there, it could be trending. If uh, if it is opening within the range, it could be sideways. But breakout can happen anytime during the day. Okay, as per that, you try to build your position 110 for the entire day. You look at OI data, max call and max put, what the market participants believe, right? At least sell premium which are 20-30 rupees, don't sell 2-5 rupees. Manage delta during the entire day, exit by 2:30. The risk is the gamma that can be mitigated by 2:30, exiting before 2:30. Option freeze can be mitigated by keeping stop loss order on far OTM orders. Is this clear? See, there is nothing much to explain the strategy. I can share my trade logs that will help you. Like that will, you understand better if you go through them. But there's nothing much more to explain. It's similar to what I explained in the bank nifty thing. Similar to this only. This is the same thing I'm doing. Just I'm building my position very slowly. Right. So if you are like new trader, avoid expiry trading and creating strangles in bank nifty. Right. Is this clear, or like should I explain more on this? Should I move forward? Okay. Yeah, the concept is clear, but managing the trade and all, like I cannot explain, I cannot say it in words. That has to happen if you like watch how I'm doing things. I'll share my trade log. That you will learn with time. So in one day you cannot like master expiry trading. That will take a lot of time. But that's why it's a risky strategy. You should know what is the risk in every strategy you are doing. This is a risky strategy. Trade only if you have enough experience. I know people who have lost entire 5 years of capital just by doing one wrong trade on expiry day. So that's why expiry trading is very risky. Know the risk involved and trade only if you can manage it. You're good at risk management. Rest, like don't do it. It's fine. Okay. So now let's move forward. Now all this while we are talking like about selling options, right? At view how at view as how I didn't get your question. No, there is no fixed time where the decay is most. So as I said, the decay curve is like it does is it's not linear that 20% decay will happen. The decay sometimes it can happen anytime. It is like out of the blue. But you know one thing, by 2:30, if the market does not, your strikes are OTM, they will become zero. This one thing you know. So you have to manage your trade accordingly. Right? But see, expiry trading also requires big capital, at least 10 lakhs. Without 10 lakhs, doing expiry is suicidal. Because anyways, you want to sell 110, 110, 110. So if you are selling one lot 110, 110, you'll pay brokerage 40 rupees every time. And you're doing 300 trades. So you'll pay a lot of brokerage also. To understand who, when market decides the decay, who can algos catch it? Oh no, I don't think so. Because it decay is something like it happens during the day. There's no okay, decay will happen at 11 a.m. Decay will happen at 12 p.m. The decay happens gradually over the day. So 1.2, 2.3, 3.9, keep decaying, keep decaying, keep decaying. So that's why what you can do is you can look at eye charts at the combined straddle. If it is going down and if it's below VPAP, try to sell those strikes. Right? Okay. I'll move forward then, like, or anyone has any other question on expiry. Okay, so all this while we were talking about selling options, right? But there are certain times when you have to buy options or when you should buy options. So there are few times when I would like to buy options. So let us see how does it work. So as I showed in the option chain, every options, like every stock or index has a max call OI and max put OI, right? As per the option chain. Right? So what we will do is this system we will use only in the last week of expiry. Why last week? I'll tell you. So what you do is find stocks trading near 1% or 2% range from the max call OI or put OI in expiry week, which means the last week of expiry. Because for stocks don't have weekly expiry. So the expiry week is the last week. So find stocks which are 1 or 2% range from the max call OI or max put OI. For example, assume for example, ICICI Bank is at 495. The max call OI is at 500, and it is the last week of expiry. So ICICI Bank will be in your radar, right? The second point is clear, right? Stocks which are 1% from max call OI or max put OI in expiry week. Okay. What you do is check. This is check, right? Check if unwinding in highest call or highest put. So, for example, ICICI Bank is 495, 500 call as maximum OI, and you see that the OI reduces by 20%. When will the OI reduce? When the call writers feel that the market access ICICI Bank can go above 500, right? So in that case, you buy the ATMC or the ATMP. Why? See, these call writers got trapped, right? So when they go like they'll want to exit their position very quickly. And the last week of expiry, why? Because the gamma is in your favor. So the premiums are lesser. And once these guys get trapped, the gamma will help you make money. The options will quickly transition from ATM to in the money. So if you had seen my tweet on Wednesday, it was built on the similar concept only. What happened is 9,500 call was having the maximum OI, right? What happened is the call OI started reducing, which means the unwinding was happening. So first thing, max call OI, put OI. 9,500 call was the maximum call OI. Bank Nifty 1% range, yes, it was. Bank Nifty was at 9,500 only. Was there unwinding? Yes, unwinding started happening. What to do? Buy 9,500 C. Okay, the gamma made you money. Yes. Is the concept clear? So this is the only time you should look to buy options because the risk to reward is very favorable. See what happens is these guys get trapped, right? So if they get trapped, then they get trapped very rarely. So the trades will also be less. If they get trapped, they'll try to exit the option, and now they don't have time to do adjustments, right? Because it's the last week, so last 2 or 3 days left, say, and the stop option is becoming in the money, so they have to exit. So what they'll do, they'll exit. So what happens is, wait. There was a day. Uh, you all can see the screen, the whiteboard, right? Is there scan available to find out stocks? No, there's no, like you can build on your own, or like there's no scan. I think you can try to figure out on your, you can keep on your radar. You don't need a scan also. You can keep stocks in your radar, right? You can check. So you, whatever your watch list is, you have to just check 10 stocks, right? So you don't need to go for a lot of like softwares. You can just take the eye charts. I think rest you can do it, like you don't need it. Okay, the whiteboard is visible, right? Yeah. So what happens is, so plus something. So suppose this is the put call parity, right? S plus P is equal to C. So what happens is, there was a day, I don't remember the exact date, it was May something something. It was 3 p.m. right? And one day before, there was some news that everyone can invest in HDFC Bank. The limit was removed. It was 3 p.m. expiry day. For example, I don't remember the exact price. Suppose Bank Nifty was at 30,000, right? So that day Bank Nifty opened with a big gap up. The previous day was, for example, 20,500, and it opened around 20,800. So one day before, 30,000 call OI was the maximum. So on that day also Bank Nifty was below 30,000 the entire day. But what happened is at 3 p.m. Bank Nifty started rising. So this 30,000 call OI started reducing because now they will panic, right? So if they panic, what will they do? They'll buy at any price because it's only 30 minutes left. In Bank Nifty, if it rises 500 points, they'll lose a lot of money. So they'll, for example, the price was 10. So they started exiting 15, 20, 30, 40, 50. And Bank Nifty started rising. So a lot of people think that Bank Nifty rose because there was a lot of buying in HDFC Bank. No, that is not correct. So what happens is, these call writers are trapped. They will exit any price, right? Because it's only 20 minutes left. So if the call prices rises, so right, put are already zero. So this equation is doing, the put is not doing anything. So what will happen is the stock has to rise. So the algos come into place. They are looking for this opportunity. Okay, call is rising, but Bank Nifty is at the same price. Not possible. Okay, let's so due to due to this, just due to unwinding, all stocks start rising in Bank Nifty. HDFC Bank. See, Bank Nifty can rise only if the constituents rise, right? So the algos come into place just due to this unwinding. HDFC Bank rise, ICICI Bank rise, because the algos have to, because if there's an inefficiency, right? If the vol will rise, the stock has to rise, right? So due to all this, the algos come into place and Bank Nifty also rises. So that's why we try to buy the call option and it gives us money. Is this clear? Like what happens? Like most people assume that there is a lot of buying in HDFC Bank, a lot of buying in ICICI Bank. No, there is not buying. It is just as per the put call parity. Is it clear? If not, then there will be arbitrage opposite. This is arbitrage, right? So like people will try to capitalize on this. So what happens is, so this is the time we should buy options. You will, I think 1 rupee option became 200 rupees that day. I don't know. I'll share the rate. So so if you are trading, that's why I say expiry trading is risky. Exit by 230. This is risky. So exit by 230, and this can happen in Bank Nifty anytime. So Bank Nifty is volatile, so this can happen. But are you able to understand what is happening? The call writers panic. They start exiting. Why do they panic? Because they will become in the money. They don't have the time to manage the trade. So they start exiting the call option slowly. First they exit very slowly. They see, okay, market is still rising. Okay, let's exit in panic. So if once they exit in panic, they'll exit at any price. So the call premiums will rise to, as per this equation, stock price also, the spot price also has to rise. So other stocks also start rising. The stock price, because the algos buy it, right? So basically, you do understand ETF, what an ETF is. So Bank Nifty constitutes of certain stocks. So you buy certain stocks in certain manner. Yes, yeah, yes, yes. So to maintain this equation, the algos will buy. So basically, it's a opportunity for them. Is it clear? See, I just explained this, like it's not like, just to make you understand, because some people have the confusion. Sarvesh, is it clear? Yeah. So algos come into place and they want to take. This is a chance for them, right? Call is rising, stock is same. Stock has to rise. Let's buy the individual stocks because they have to rise to maintain this equation. So this is what. So this is the only time when I like to buy options. Why? Because gamma is with you. Options are cheaper also because it's like very close to the expiry. And so basically hero or zero, as we say, either it will become zero or it will become a hero. So what you can do is, in this eye chart, there's something called as OI monitor, right? Yeah. So what you can, for example, you can, if you can see that the OI is, the spot price is rising. So you, first thing is keeping stocks in radar which are near to the max call OI, max put OI. For example, yesterday, if Bank Nifty 21,000 was the maximum, 20,000 was the maximum call OI. For sellers to panic, the stock price to move again them initially, right? What? Why again? What you're trying to say? For sellers to, they panic because they don't have time to manage the trade, right? For example, you are in this trade, Bank Nifty is at 22,000. You have sold this option at 20 rupees at 920. You expect that this option will become zero. Now it's 3 p.m. Bank Nifty is coming to 20,000. The option has become from 20 to 40. You are still finding okay. Till the time Bank Nifty is below 20,000, this option will become zero only. Now Bank Nifty is 20 points above 22,000, which means your option is trying to become in the money. Now you will panic. Okay, now I have to exit the trade because I cannot manage the trade because I don't have the premium on the put side. If I want to manage, I want to buy futures and all. If that also goes wrong, I'll again lose money. right? No, it won't show the highest and this. For that, so you can use this for highest. There's a link I'll send you on Telegram. It sends you the OI chart every 5 minutes. Jigar, there's a link on Telegram. There's a channel. It's a free channel. It will send you the OI chart every 5 minutes. Okay. We find, yeah. So yeah, the opportunities are rare. Yeah, I'll say, okay, let me send the link. Wait, how do I send the link? So if you are on Telegram, I shared the link with someone. I don't know. We had shared it. So the link is search NFCW in Telegram. NFCW. NFCW. NF in Telegram. Join that channel. We are also building our own OI bot that will like scan the OI, and so it will be free only. So once that is done, we'll share that also. Right? Yeah, the opportunities are lesser, but these are times when you should look to buy. Is it clear? See, I am an option buyer. I rarely buy options. Like, and even if I buy, I panic. So when I sell options, I'm very calm. I don't panic. If I buy options, I panic because that's my temperament. I don't like to buy options. But these are times when you should try to buy options. And my track record in buying has been very bad. Like I've never been able to capture 1:20. So that's why, like, it depends on you, but a lot of people are very good at buying. They can capture buying, but this is the only time I found that buying is very useful. In fact, I'm doing a very detailed back test on this currently. So the first thing is, mm, again coming to it, first try to find out max call OI and max put OI of all stocks. Find out stocks in the last week of the expiry, so you have to do it only in the last week, which are near 1% or 2% range from the max put OI call OI. Keep them in your radar. Check if there is unwinding, 20% unwinding, or the ATM CEP is increasing. Yeah, like I showed you yesterday, right? The P premium POI when was greater than the COI, the crossover happened, right? If that happens, buy the ATM option and hero or zero. Is it clear? Like completely clear? This is also 100% systematic. No discretion involved. Only discretion is involved in expiry trading and managing Bank Nifty intraday. Everything is systematic. Is this clear when to buy options? You can add your old filters also to this. But these are times when you should look to buy options because the reward, risk to reward is very much favorable. Okay, I'll explain the crossover. But everyone is understanding why this logic. See, every strategy is built on a logic. And I want with time you build your own logic also. Yes, yes. For stocks, it's a monthly expiry. Stock. See, every strategy, if you see, we discuss so many strategies. Every strategy has a different logic. In something we are selling. In this, we are trying to find which option. If our option writers are getting trapped, because the logic is simple. The gamma will be with you. These writers will panic. So every strategy is built on a sound logic, and with time you have to keep evolving your strategy. Does not mean these strategies will work forever. Some will not, but you have to keep evolving, right? So yeah, someone said. So I'll just show you. So yeah, if you can see this, what did I mention? This was Wednesday 2 p.m. Nifty was at 9,500. But what was happening? Call OI was increasing, put OI was also increasing. So what I said, Nifty is a 9th. This is the OI chart of 9,500 CNP. Both side OI getting added. Crossover of this will decide the next move. Okay. So crossover as in if put premium is greater than the call, put OI is greater than the call OI, which means the put writers are winning, which means the expiry will be on the upper side. So what happened next day? On that day only at 2:35 p.m. You can see the call OI started decreasing, right? Why did it decrease? Call writers panicked. Yeah, Nifty was at 9550. They were like, now it's becoming in the money. No point holding it. Let's exit only. Take a loss. But the put OI started increasing, right? So what happened? Put OI crossed call OI. What happened? Short covering rally. This was a short covering rally. The short started to cover. I explained why did the price go up. A day prior to expiry, OI data combined with price helps in providing directional insights. And the logic is closer to expiry, ATM options have highest gamma. And as these options become in the money, option writers run for cover, leading to a short covering rallies. Is it clear? Who asked? Rahul. Yes, Abhishek. For stocks, it's monthly. Rahul, is it clear? No, second or third week, what happens is the writers won't panic, right? Because they have time to do adjustments. What I can do is I can sell put because the put also has premium. I can buy futures. I can do a lot of different things to manage my trade. I can buy in the next month. I can do a calendar. I won't panic. But if it's the last week, I'll panic, right? And second or third week, the gamma is also not with you. The last week, the gamma is also with you, right? Yeah. Okay. So I think after the break, we'll focus on it. Let me know what it is. Yeah, we'll focus on like position sizing, risk management, money management in detail. So now before like going for a break, let's just again revise what we did today and focus on how the strategies are built. Like what is the logic? As I said, a hypothesis is important, and then you build strategies around that. Because with time, markets will constantly keep evolving. You have to, if you want to survive in the markets, you have to also evolve and change your strategies, right? So what happened is like yesterday we saw that four patterns. If the market if the previous day high low is broken, right, that time we play directional. But if the market is opening within previous day range, generally it is sideways. So it's better to create non-direction strategies on the index. This is on the index, not on stocks. Don't do it. If market is opening outside previous day, this is the violent plot. So then we check the equity curve was looking decent. So intraday, this is only if you have the experience, then only do it, else avoid A and B part. So if the market is bullish, you create a slightly delta positive skewed delta, manage your trade the entire day. One more thing, combined chart should be below VWAP, combined triangle or shadow chart should be below VWAP and below 20 SMA. Same thing for if the view is bearish. Yeah, this everyone can do. If it's opening within previous day range, create a straddle with a stop loss of 40-50 points, and you can wait in the trade and exit as soon as the day high or day low of the previous day is broken, right? Then we discussed the Wednesday positional strategy. The logic was that Wednesday overnight the decay is maximum, but in spite of creating a strangle, why not try to figure out a way to sell naked options that would expire worthless? So what we did is we tried to find out the mode. A calculating mode is simple. Uh, it will be in rally mode if close is greater than previous day high, and it will continue to be in the rally mode till the time it closes below previous day low. Same for decline mode. We try to find out a mode. Then we see when if it's a rally mode, Wednesday low minus 200 gives good money, but selling those options naked is risky. Instead, sell that low and buy a protection. Exit next day morning. Okay, and you can generate 0.2 to 0.4% of capital. The accuracy I showed you. What is the accuracy? Okay, and the only time you lose money is if the opening is outside your range, outside your sold option. But on next day, Thursday, if you already sold that option, you're getting money, you can sell the counter options also, right? If you're trading expiry. So what you do in expiry extremely risky, to be done only if you know how to manage options. You try to figure out what the market looks like based on the opening and based on the how the price is getting accepted or rejected about previous day low. As per that, you try to create your view and you start with 110 position and build your position slowly during the entire day. For additional information, you can look at the max call OI put OI for to find out what the market participants think the range is. You manage the deltas for the entire day. Make sure that you always keep stop loss because this is, if not done properly, very like risky. So exit by 2:30 to avoid gamma risk. And there are option freeze can also happen, which is a risk. So for that, what you can do is keep stop loss buy orders in OTM options, right? And this strategy, I would say, like better avoided if you don't have the experience. Don't do it only. Okay, all the time we discuss when to sell options, but there are times when we should be option buyers. And the only time I like to buy options is when people who are those sellers get trapped. So how to know they are trapped is first find out max call OI and max put OI of each stock in the last week of the expiry. Try to find out stocks which are near the range of the max call, max put. Check if unwinding at least 20% is there, or you can also check that, as I said, the crossover is happening. If that happens, buy the ATM C or P and let gamma be with you. And the more closer to the expiry, the more better it is. So yeah, this is a good time to buy options, and because the risk is the option premiums are very low. The risk is low, but the reward if you go right is very like high. Is it clear till now what we discussed on, like except the expiry trading? I think most of things are very 100% systematic. Monthly income we'll discuss after the break. Is it clear? Any way to get idea of 3 p.m. move likely to happen? No, there's no way to figure out that. Like I don't know any way of such way. There was a see the loss is defined, right? The loss is 150, 160 points on Bank Nifty. So that's why I said you have to. So you hedge in such a manner that you already know your loss. That's why you're hedging the trade, right? The loss is defined. Yes, you can do. Yes, you can do. So if you see last week, if you had bought the 9,500 call option, it became almost 15x, 15 times. Sandeep, clear? Is it clear? But these trades are also rare, right? So as I said, every system has a different risk to reward characteristics, right? Yeah, yeah. As soon as you observe, you can buy. So every system which we discuss has different risk to reward characteristics and different payoff. So that's why, like, and some systems are very less frequency, some systems are very high frequency. So you have to trade all them together so that you get the best of everything, and like your drawdown is limited. If the markets are trending system will make money, sideways will lose money. Okay. If you get some time in last, please throw light on HR, how useful it is while taking trade. Okay, I'll do that, Deepak. Just remind me. Anything else, or we'll then like go for a break and we'll be back by 2 p.m. Hello. Okay, so break, right? Yeah. Okay, let's go for a break. So we'll back by 2 or 2:10. Okay, and then we'll discuss more monthly strategy. And the last session is the most important because it's about risk management psychology. Okay, 2:10. Fine. Yeah, we'll come at 2:10 then. Okay. I'm I'll end. So the link will be open. Come here at 2:30. Bye. Bye. 2.5 times. 2.5 times of the premium. 30 into 2.5. Is it clear? Push. Yes. On expiry day you can. We'll start, but next strike is after 100 points. What does it mean? Next strike is after 100 points. Let's do one. Let's take the question in the end. Now let's start first. So, Push, we will note your question. We'll discuss this. Okay. Yeah. Yeah. So see, till now the strategies which we discussed were based on uh, basically price. Some were based on volatility. Some were based on even time. And some were based on concept of trend. The markets will be in trend. Some were based on the concept that the market will be sideways. There's one more thing. I won't discuss the starting points. Someone had asked regarding. So this is not a system which like I'll be discussing. Just will help you with the starting point. Someone had asked yesterday. Yeah. So basic pair trading is basically stocks which are moved together historically, and due to some reasons which are temporary, they deviate. Your hypothesis that they will again revert back. So you short one and long another. So this is the concept of pair trading. I'm not going to discuss this. I'll just give you an idea what how we do it. So basically, what we do is like I won't discuss the statistics of p-value and the lag used. Basically, but this is completely based on statistics. What we do is first we try to figure out. So basically, out of all the FNO stocks, for example, 200 stocks, so we do 200 C2. So these many combination is possible. So 200 C2. So we run each stock. We run the correlation with other stocks, and so first criteria is the stock should be at least 70% correlated. Okay, so we get a set of stocks. After that, we run for co-integration. So what basically co-integration is, I won't get into the statistic part, but basically assume that you are going with your dog and you have a leash in your hand. So the distance between you and the stock and the dog will be maximum equivalent to the length of the leash, right? Which means you and the dog, there's something which is binding you all together. So that's what co-integration is. So correlation could be due to some other reasons also, but co-integration basically tells you what actually is like how do the stocks move together or no, to like understand in simple manner. So we then run for co-integration. The first test is we check for correlation. Second, we check for co-integration. Once, so we check for co-integration at a certain statistical value, and then if both are, and there's a test called ADF test. See, I'm just giving an idea. I won't be discussing this. So then, second, after doing this, we get a set of stocks. Then what we do is Yeah, it could be like aviation, energy, so it could be anything. So you get a set of stocks. Then what we do is, once we get a set of stocks, then there's something called a Z score, which is basically the standard deviation away from the mean. So on the basis of that, we either long one stock or short one stock, because our hypothesis is that it will again revert back to the mean. The third step is that after that fourth step, there are two types of time series: trending or mean reverting. We want the time series to be mean reverting. So there's something called as a Hurst exponent test, which tells you whether time series is trending or mean reverting. So if the trending time series is mean reverting, then only we take the trade. And there's something called as half-life, which basically tells you average time it takes to revert back to the mean. See, if a stock, if the combination of the time series takes at least 2 months to revert back, so you won't hold the trade for 2 months. So you want the half-life to be less than, for example, 30 days. Basically, you don't want to hold on to your trades for more than 30 days. So this is what like we have done. So you can see that we plotted the correlation, then we plotted how the stocks move, then we plotted the ratio of the stocks, and in this you can see that there's certain p value and then Hurst exponent correlation. So the lot of things are there, but I think this is not the part of what we want to do. But just to give an idea, if someone wants to go deep into this, and I guess I'll be doing a class on Learn app also on this, so that time you can like, if you want to learn, you can do this. But today I won't be discussing this. Not 1 year, like I do it. So if you can see, I've done for 1 year, 3 year, 5 year, 10 year, right? This is just to give you an idea, like what other strategies also possible. This is very statistical in nature. So like you need to have a statistics background also. I'll have to explain you statistics to make you understand the strategy, which is not what we want to do today. So this is just an idea. Like if you want to study, you can read online. There are a lot of books available. And if someone wants to, like, he can message Dhiren, he'll share some books also. There's a book of EP Chan which you can start reading if you're interested in this. But the purpose to show you this is that what all strategies are possible. So this is also one strategy which is possible. The accuracy is also very good in this, right? But this is completely based on statistics. No, this is not machine learning. No, Deepak, I don't think there's any ready-made scanner. This is not machine learning, Abhishek, but you can apply machine learning on this to find out the best pairs. Yeah, the results are good. Okay, so I haven't checked my FNO. You can check it. But I like to like build things on my own. I don't prefer like any software. I like to build things from scratch because I can customize the way I want. Okay, so this is just to give you an idea. Like you can build strategies on price, you can build strategies on volatility, you can build strategies on time value, you can even build strategy based on statistics. So this is just to give you a concept. And anyone wants to, because I cannot explain, because if I explain this will only take 3 or 4 hours. But this is just to give you a concept that even strategies are built on pair trading. This you want, if you want, you can explore it, but this is how we do it. Like we don't like, so we try to use a lot of statistics to make this strategy. Okay. So, yeah. Is it worth spending time on learning pair trading? It depends. See, like I think like other strategies are also like sufficient. It's not, but as I said, as a trader, I like to learn new things, so I like to do it. But it's not required that you have to do it. If you think that you have a lot of capital and you want to deploy it to another strategy, you can explore this, right? Yeah. So just to, because this is not one, this is the thing which I'm not covering. I just wanted to give you a brief point, like what all things you can look at if you want to build a strategy. This is also one thing you can look at. And this strategy, I built it, like it took me a lot of time to build, because initially I didn't use any strategies. I was randomly taking trades. Then I thought, okay, let's do correlation. Then it was not giving a good result. Then I started with uh, then I started with co-integration. Then what was happening is sometimes I was losing money. So then what I did is I added a uh, Hearst to check whether time series is trending or mean reverting. Then I added another filter. Okay, I want to take trades only in which the half life, which is the average time to revert to the mean, is less than 30 days, 40 days. So this is how you build a lot of things. Research paper. Yeah, I think there are a lot of research like papers. I don't. You can check. I haven't checked any papers, This is basically, I read it from EP Chan book. You can read that book, Algorithmic Trading. And I read 2 or 3 books, and like from there I've like combined the concept. So you can read this online. I think this is not required if you not don't have a maths background also. So you can skip this. But just to give you an idea, I showed you this. So now let's get started. Like, yeah, EP Chan, yes, EP Chan, Algorithmic Trading. Okay. So now let's get started. So now we discussed a lot of strategies. So let's now discuss a monthly income strategy, right? Like we discussed all strategies which are mostly intraday, but what if you want to like uh, do some strategies which you want to generate some consistent monthly income? I think Jigar was asking it, right? So let's see how we can do it. This also I'll do it very quickly. So basically, like Python people have already done it. So others, I'll just give you an overview. I think it's very basic. So basically, we'll use 2 concepts. One is mean. I think mean everyone understands. Standard deviation is basically how spread out the numbers are in a simple terms. So basically, in market terms, standard deviation is a measure of risk. So basically, volatility, what we say is basically standard deviation, right? I think this, those who join new, I think they understand this, right? Standard deviation. Yeah. Others also, right? Jigar and others. Yeah. So basically standard, so you don't have to go into the mathematical part. Basically standard deviation is equivalent to volatility. If you, even if you know this is fine, right? So let's, how can we build a strategy around this? So, okay, this is one concept. The, you can see my screen, right? The standard deviation screen. The slide you can see, right? Okay, yeah. So, okay. So basically, it is assumed that stock prices, stock daily returns follow normal distribution. So a normal distribution is something which looks like this. Basically, uh, the curve is symmetrical around a mean. So as per statistics, at one standard deviation contains 68% of the curve. Two standard deviation 95% and three 99.7. How these numbers curves, that is a topic of area under the curve. You need to know calculus. You don't have to go into that. You just have to know that one standard deviation has 68% area, two standard deviation 95, three as 99.7. Okay, so now I'll just okay. So now till now what we know how to find an average. Okay, we know that. We know what is standard deviation. Standard deviation is basically volatility, right? Just see how I'm building the strategy. Okay, this I know. Okay, one more thing is stock daily returns follow normal distribution. So one standard deviation 68% values are there. So this 68% is the confidence level, which means I'll tell you how do we use it. So first, do you use graph March models for forecasting volatility and other no, I don't try. I know I don't use, because in my opinion, forecasting volatility is not easy. Like it's itself a $1 billion question. So there are a lot of different models. I like to do things which are practical and can make money. I don't like to get academic, so I don't do it. Ashutosh, I like to things which are very simple and like can be practically implemented. So if you see the pair trading thing is something which is like very heavy on the statistic side, but that is something can be used to make money. Forecasting volatility cannot make money. Okay, as a trader, I always think, what is it worth invest? Is it worth my time if I try to forecast volatility? Can I make money on that? So it is not possible. So rather, I do the event trading thing, right? Because I know the volatility will drop. So forecasting volatility itself is a very big question, which like I don't think anyone has been able to solve it. Is it clear, Ashutosh? Yeah. Okay. So yes. And see, a lot of people think that quant is something like you need to know, do very like complex things. In my opinion, quant is anything that can be used, that data can be used to make decisions. If you see in the entire 2 days, except the BNF thing, everything was completely data driven. It's either a buy, either a sell with stop loss, everything, and it's tested, right? Even the budget thing, if you I plotted on minute by minute, I could tell what is the stop loss, what is the target. Was there anything complex about it? No. So a lot of people have the confusion that quant is something you need to be like it. You need to have a very good degree in mathematics or something. No. If you want to do advanced stuff, it is. But I think if you want to make money, even simple knowledge is fine. Okay. So let's proceed further. So now, see, till now we're discussing strategies which were uh, intraday or majorly intraday. But now someone asked that, okay, should there be a strategy which can generate monthly income? Yes. So how to build that strategy? Let's see. You all have to back test and you'll have to go home and like, I'll give you an idea. You'll have to do more research on this, but I'll give you like most of the idea how to do it. So first thing, what I know is uh, every month I know options expire worthless, right? That is the first starting point, which means I can sell both call and put to make some money. Okay. So first is I am building a monthly strategy. I'll build the strategy with you. Monthly income. So first question is options expire worthless most of the time as per studies done. So we can sell FAR, OTM, CE and PE, right? So that they will expire worthless. Okay. But the second question is yes, Sarvesh. Two, but why we don't sell two standard deviation? I'll show you that. So we can sell C and sell FAR, OTM, CEP. Okay, this is a starting point. But what to sell? What options to sell? That is the second question. What options to sell? Right, that is the second question. Yes, Ashutosh, right. That's the reason we don't sell three standard deviations. So first is I'm building the strategy. First is okay. I know options expire worthless. Most of the time market is sideways. So if I sell both call and put, I should make money. Okay. So first is we have to sell for OTM call and put. Second is what options to sell. Like for example, through 200 points away, 300 points away. That is the second question. So let's try to answer the second question. I'll just and then we'll see what to do. So basically, this is a bank nifty data from 2016. So what I did is I plotted the daily returns. This is the daily returns. I'm just highlighting it. So this is basically log of current close divided by previous close, right? If I do this, I get the daily return. Is this clear? So from this, I can find the average daily return. The average daily return is basically the average of this right into 100 annual. Is this clear till now? What did I do? These are the okay. Let's. Is it clear? Yeah. So basically, you can see the average daily return is almost zero only, and it was clear from the Bayesian plot also, right? Now this is the average daily return. So as I said, what standard deviation is the measurement of volatility. So can I find the standard deviation? Standard deviation of what? Of daily return. right? It will be equal to standard deviation I'll do this into 100. So I'm doing it to 100 because to convert into percentage. So this is 1% standard deviation. Till now, is it clear? See, here I did multiply into 100, so I'm multiplying here. Yeah. So basically, now I know two things. I know the average daily return of Bank Nifty. I know the daily standard deviation. So what is the standard deviation telling me? 1% is the daily standard deviation, which means Bank Nifty from the current price can fall 1% and can rise 1% on average on a daily intraday basis, right? This is because it's a daily standard deviation. Is this clear? But I want to generate a monthly income strategy. So what I need to know is the monthly standard deviation. We'll see how to calculate this. I'm just giving you what we want to do. So we want to calculate the monthly standard deviation. But as I said, you can see the statistics chart. 68%, I can say with 68% confidence that value will be within one standard deviation. If I want a higher confidence, I'll move to two. So with two standard deviation, I can say within two standard deviation, 95% of the value will be there. With three standard deviation, I can say 99.7. So now I know the daily standard deviation, right? Is everyone getting this? Okay. So to calculate a monthly standard deviation from daily is equal to daily into square root of time. So how many days are there in a month? People will say 30, but trading days are only 22. So you'll do square root of 22. So what does this say? So monthly standard deviation of Bank Nifty is approx 5%, which means in a month Bank Nifty can fall 5% up and can go 5% down. Right? We also need the monthly return also, right? Because this is a daily average return. So to calculate monthly, we will do this into 22. But nowadays it's moving in the 3 4 days. Yeah, nowadays it's moving 3 4 days. I agree. So that's what we'll see like how to do that. Right? Because see now the market regime has only changed, right? Till now, is it clear? What did we do? We had the Bank Nifty data. We calculated daily returns. From the daily returns, we found out the standard deviation of daily returns. We converted the daily. I'll give you the notes. We converted the daily standard deviation into monthly, which is basically daily into the square root of time. Time is square root of 222 because square root of 22 is 22 days in a month. Monthly returns basically return into time. Is this clear till now? Everyone? Yeah. Okay. So now I know one thing that I want to sell FAR, OTM, CP. Yes. What options to sell? Okay. So I can say at 68% interval, 68% on confidence, I can sell one standard deviation options away, right? Okay, wait. Uh, I am new to this. Rajesh, are you finding it difficult? Yes, yes, Raj, you will get the notes. You will get the notes, Rajeshi. Because this I had covered in the statistic class. You can watch the recordings, Rajeshi. Okay. And any doubts, you can like again contact. Fine. Wait, just a second. Hmm. Yeah. Okay. So we'll start. So first thing is, again I'll repeat. We calculate the daily returns. From the daily returns, we calculate the daily standard deviation, which is basically the volatility. From the daily, we again convert to monthly because we want to generate a monthly strategy. And someone would say, why not weekly? Because in weekly, the gamma risk is high. So weekly selling options is riskier overnight. Monthly is relatively safer. Okay. So yeah. So now first thing, we can sell FAR OTMC. Okay. What options to sell? As you found, so what did I say? 95, 99.7. So one standard deviation. So how do you, what do you the range is basically average plus 1 into standard deviation. If you want to calculate this is on the upside. So the upper range is the formula clear? Then we'll do a example also. Is this clear? And the lower range will be average minus 1. Sorry, this is not plus, this is minus. Is this clear what I did? Upper range and lower range. Basically, what is volatility telling you? How much can bank nifty move? So what current market price, what, how much it can move? What is the upper range? What is the lower range? But how confident are you? 68%, right? Is everyone clear? Like then we'll do an exact example also and try to find a way. Is this everyone clear? Yes. So at 95, what should I do? Can anyone tell me average plus what? Yeah, 2 into standard deviation. Okay. Is this clear till now? Okay, now I'll just remove everything. Let's try to calculate the range. So basically upper range, lower range. So assume bank nifty price is 21500 CMP, and this is the monthly standard deviation, this is the monthly return. So what is the monthly movement bank nifty can go? Can anyone tell me what, how should I proceed? Shouldn't you use one tail for this? I didn't get your question. Oh, yes. So what we will do is monthly return plus this into monthly standard deviation. Or it will be by 100 because this is percentage. Wait, what? Someone is asking questions. Wait, while I do one thing, I'll share the Excel with you so that you can also see. Wait. I'll share the Excel. I'm sharing. Yes. Yeah, she was right because we are using ln, so we should use exponential. But sorry, I gave it to Shishir. Share the link. Just open it. So basically, just this example is already there. Okay. So assume that the volatility of increase 27%, right? So now using this is the I'm calculating this is the yearly volatility. I'm trying to calculate the yearly. If I assume this is 2%. What you are so CMP is 782. You can calculate the lower range using same thing. CMP minus the standard deviation into return into the basically from the average. So basically I want to calculate the standard deviation, right? So from the current price, how low or high the stock price can go. So the current price is G5, you can see here, minus F5 into G5, which is basically the standard deviation in number terms. If I multiply this, I get a number, right? And this I'm doing into 3 because this is 3 standard deviation. Every for a low. Don't get stuck in the calculation part. Is the concept clear? Then how to apply it? You can do the calculation at your home. How to apply this, I'll tell you. Is everyone able to find out, can figure out a range for the monthly? Okay, so yeah, once the range is there, how we will use this, I'll show you. Okay, once you have the range, what we can do is, so basically, let's do one standard deviation only, because if you go far away, the premiums won't be there, right? So how I take approach this problem is monthly 2% return is good, right? Is everyone able to is everyone able to understand the calculation? See, don't get stuck with the calculation. The calculation is very simple. I'll give you a formula sheet only. You can just plug and play. Just let's move forward with the concept. Okay, so basically the concept I'll again repeat. I won't go. So basically you calculate the daily percentage returns. From the daily percentage returns, you calculate the standard deviation. Using that standard deviation, you can find out a range for the instrument, because for every instrument the volatility will be different, the range will be different, right? Is this clear till now? Okay. Yes. So if I'm an option seller, do I want instruments with low volatility or high volatility? low, right? Who said high? Why high? I'm a seller, right? No, but the premium is high, the risk is also high, right? See, if the premium is high, it is high due to a reason because the instrument moves also that much. If you see Yes Bank, the premium is very high. You can just see, check this side. This, the lower range in Yes Bank I'm getting is minus 2.5 because the yearly volatility is only 106%. No, I am not betting on volatility, right? I don't have any view on volatility. My view is to generate consistent income and sell far OTM options. So what will I prefer? Will I prefer instrument which has low volatility or high volatility? Abhishek, you totally deviate from the topic. I don't know what are you doing? Did we even mention IV or HV? Yes. So basically, our goal is to find instruments which have low volatility. So our goal is to generate 2% monthly. How I see this is to sell one lot of options on an average. For example, you assume you have you need 1 lakh rupees. So 2% of that is 2,000, right? So 2,000 in term of Nifty points is this by 75, 26 points, right? Which means if we capture 26 points monthly in Nifty, and why Nifty? Because positional do Nifty because it is less volatile. Bank Nifty is very volatile. So we need to generate 20 average 26 points, right? Okay. So yeah. So what we can do is okay. So average we want to generate 26 points. So what we will do is how I do it is I don't do only Nifty. I select certain stocks. Okay. So what you can do is, for example, suppose you're doing Nifty. Okay. So what I do is that I'll cover in money management. My target is only 1.5%. Why 1.5? Because my money, I don't keep it in the markets. I keep it in FD and I pledge that FD. That we will discuss in money management how to do that. So five. So on average, yearly I get 6.5% from FD, which means 0.5% monthly the FD is giving me. So I want to generate only 1.5%. 1.5, which means 1500. So I want to generate only 20 points monthly. If you see daily is 1 point. 1 point daily is Nifty possible, right? So now I told you, right? You want to know, you want to ask the question what you want from the market. So I want 20 points monthly because this strategy is a passive strategy. I will create and like I don't do any much like you don't have to do much management with this. Okay. So I want to generate 20 points monthly, right? So now what will I do is, so if you do this, you can find out the at one standard deviation, you can find the upper range and lower range for monthly for Nifty. See that the combined premium is at least 20 rupees. If yes, you can sell it. Okay. Is this clear? But what you can do is because you are selling this naked, but the weekly options which will be expiring this week will be very cheap, right? So instead of getting a combined premium of 20, target a combined premium of 30 rupees and every month spend 2 rupees in buying options. Is it making sense? Because you are buying weekly, at least in case of big gap down, your loss is at least capped. Is it clear? I'll give you a study on this, which you have to do yourself. I'm just giving you a concept. Yeah, kind of Deepak. Yes. Right. Okay. Now this is there. But can we add a trend filter to this? trend filter, which means, as I said, right, the trend, you can decide the trend using a moving average. So let's add a trend filter. Can I add a trend filter if the stock is above 20-week moving average? I will sell only puts. If it is below, I will sell only calls. Yes, Sandeep. Yeah, same. See, you can sell both, but if you want to add a trend flavor, can you add a trend filter? So basically, if the price is about 20-week moving average, you will sell only puts. If the price is below, you will sell only calls. Is this point clear? And you can sell in the monthly and buy the same option in the weekly. This is basically a reverse calendar. Is it clear? Yeah. Or another way to do is you figure out the range, create a iron fly, sell the strangles, buy protection. No management required, right? You can do that also. So now just let's see what if you do this in Nifty currently. Optra. Let's refresh it. See, this is not a strategy to generate good return. This is a strategy because your capital is lying idle overnight. Intraday, anyways, you can get leverage. So you can try to generate 1%, even 1% you generate is it's good, right? Yeah, price not 20 day, 20 week, I'm saying. See that you can, yeah, you can optimize, you can sell both. So there are a lot of ways you can directly create an iron condor. Let's see if we what if we create an iron condor. So Nifty is 9859, right? So selling a 9,000 put is safe because we saw that the maximum OI is also 9,000, right? We can sell 9,800. 9,000 put, right? The maximum OI was at 9,000. We saw it yesterday. Yeah. And we can sell a 10,500 call. Is this clear till now? You can come for the monthly selling strike. You can even you look at the max OI data also, right? So if I even if I create this, see I can generate 8% in a month and see the range. Even if Nifty falls 1,000 points, I'm fine. Rises almost 800, 900 points, I'm fine, right? So what if I buy 9,000 put in the weekly? So payoff won't be correct in this, so I won't add it. This is just 12 rupees. So instead of buying this at 12 rupees, you can buy the break even also 8,800. 8 rupees. So basically, the goal is to sell in the monthly and buy in the weekly. And if you don't want to do that, you can do the same. You can buy in the same expiry only. So you can buy 8,800 E buy. Suppose you carried this strategy on Friday, right? Your loss is capped. You don't have to worry. You're getting maximum 5%, but I would say you won't get 5%. Even if you get 1%, it is fine, right? And you can keep rolling the call downs. As the market goes down, the 68 will become 20 rupees. You'll exit and sell another option, which is 68, right? So the loss on the downside is only 100 points in Nifty, which also you can cover. And if you're a new trader, buy in the same expiry only. Don't buy the weekly. Buy in the same expiry. Because in the new expiry, if the VIX rises, the current week won't be affected by the volatility. The FAR month will be affected by the volatility. That happened in March. The monthly options volatility shot up. The weekly options, because the weekly options will expire, so the volatility effect will go away. Is it clear? So basically, to build a monthly strategy should be completely hedged. Target should be only 1.5%. Or if you want to take some risk, you can generate 2-3% also. So how do you really generate? You will sell strikes which are slightly lower. So I am selling 9,000 put, 10,500 call based on OI data or based on the range you calculate. Okay, protect the downside. Be willing to take the upside risk. It's fine because upside gaps are like less frequent. Downside you are protected, right? So loss is only 7,000, right? But as the market keeps going down, you can exit this 10,500 call at 20 rupees and again sell an option which is at 10,000. You can sell a 10,000 call which is at 70-80 rupees. Okay, Deepak. So basically, I would say don't do much adjustments in this strategy. Basically, this strategy is to generate passive income. So don't do much adjustment, but adjustment you should do only, for example, market is at 9,800, Nifty comes to 9,200, right? So when it is near to your sold option, the call option, for example, the 68 rupees becomes 6 rupees. No point holding a 6 rupee option, right? So exit that and Nifty is at 9,200. You can now sell a 10,000 call, right? And one more, correct? Yeah. So, or see, if you don't want to do anything, you can hedge both the sides. So on the upside also, you can buy the 10,600. This is basically iron condor only. But if you see this, so this is your payoff, which looks like it. But I don't like to buy both the sides because, so what you can do is, we discuss how to trade intraday, right? So you can create these legs intraday and buy the protection at close. Anyways, your target is only capturing 20 points, right? Is it clear to everyone? So basic goal is to figure out range of the instrument. So put side, you don't do anything, right? Because put side already the protection is there, right? Your max loss is already capped on the downside. Always protect the downside. Is it fine? So I'll again explain what did we try to do. So basically our goal is to sell those options which will expire worthless. To find out those options, we basically try to find out the volatility of the instrument. On the basis of that, we try to figure out a range based on that volatility. You can also look at OI data for additional confirmation. You can sell both call and put and buy the protection on the downside, which is basically a broken iron condor. Or you can do one more thing. You can sell naked options as per trend, but that is slightly riskier, but generates good return. So I would say this is something which is slightly better because 100, there's the 100-point loss, and if you can cover this also. If I sell this option one more, you won't sell, but if you, the loss on the downside is very low. I think 2,000, 3,000 rupees, 2,600, right? So which basically you can, if you can get more premium on the upside. Even if you carry this strategy on Friday, even if the SGF Nifty is gapping down, you don't have to worry, right? Because the loss is capped. So yeah, black swan, Abhishek, on the downside, anyways, the black swan is capped, right? There's no risk on the downside. So you, on the upside, obviously, if there's a big gap up, you have to exit in a loss. But generally, the probability of that happening is much lower than on a downside. And you will lose money only if this happens overnight, right? Intraday, if the movements are there, you can manage. Yeah. So I would advise, yeah, sell the strangles and buy the downside protection broken. See, this is good, right? You are getting like Nifty 1,000 points downside, the break even is upside 600 points break even is, if it remains in the range, you get 5%. I am saying you won't get 5%. You will get less, but your target is only to make 2%, right? 1.5%. Right? And if you want to build this into a system, do one thing, try to find out why less though. What why less though as in? Yeah, it won't, this 5% is if it remains in the range, right? If it is not in the range, it won't be 5%, right? That is the maximum profit. Yeah. So basically, if you want to build this into a completely like systematic system or a system driven, like a system is, what you can do is you can try to figure out the volatility of the instrument, try to see that you generate strikes at one standard deviation, see that you at least get 25 rupees premium, sell those naked, just to back test and see what happens, right? Or you can back test if you create a iron condor at the starting of the broken iron condor at the start month. I think I tested it, the accuracy is almost 86%, right? And if you do this, the loss is also capped. So you can do this and try to diversify also. You can doing in Nifty, doing certain other stocks also, which are less volatile. And how to find out stocks which are less volatile? You can run the daily standard deviation and see which stocks have the lowest standard deviation. Is this clear? Or for monthly income, one more thing you can do is, one day, yeah, 30 days or 40 days before expiry, and you exit the trade like 1 week prior to the expiry, because the last week the gamma risk again is there, right? We exit the trade 1 week prior to the expiry and again move to the next expiry. Right? So this system like is not to generate alpha. This is to just generate consistent income, and the alpha generation will happen how you trade intraday and other strategies. But as your capital is lying idle, even 1.5% monthly is not bad. And sometimes you will be having losing months also. So average you can generate 1.5%, right? Okay. Yeah. So, and one more thing you can do in the monthly thing is, as we discussed, like for example, you find stocks which are bullish, right? So why to sell calls in that? We can create a credit spread, right? Sell a put, buy a put. For example, a stock which is bullish in the daily time frame forms the support. For example, form the support at a moving average, form the bullish candlestick pattern. Instead of selling a both call and put, what you can do is you can sell the put and buy a protection, right? You can do that also, credit spread. Is it clear to everyone? Yes. So just to give you an example, for example, assume you believe that Reliance is bullish. Any stocks where we can do iron condor? So I like to stick to stocks which are like part of Nifty. So you can do Reliance, Infosys, TCS, ITC. So diversify. See, in the month, diversify into 4 or 5 stocks. One will hit stop loss, but 3 or 4 will give money. Right? So for example, assume that if you are bullish on Reliance, you believe that 1400 is, you sell a 1400 put and you buy a 13. You can create this strategy also, but someone will say the loss is 20,000, the profit is 9,600, right? But see, you will lose this money after 1381, which means Reliance has to fall 80 points. So this can also be done for monthly income. So you can create. So I would suggest in one or stock, two stocks. So what I will suggest is in one stock create a bearish view, one stock create a bullish view, and one or two stocks create sideways view. Is it clear? So that you're diversifying your risk. See, if the market crashes, the bearish will give money. Sideways or anyways, you have bought protection. For trend confirmation in fundamental, is it? No, I'm just saying, see, you can use anything. You can use a 20 daily also. It's not, it's fine. But what I found out is that in the 20 daily, if I want to sell options, it will quickly change. But I want to sell positional options, right? So you can use a daily, it's fine. See, trend is, as I said, that it depends on your time frame. Sandeep, is it clear? Oh, Rajesh, I think it's not required because I don't remember any strategy. Like I don't try to remember the name of strategies. But yeah, there are books I will give it to you. There's a book called Bible of Option Strategies, which is a very good book. But I think if you want to be a good trader, don't try to remember strategies. Try to create the strategies on your own. Don't try to remember, okay, I'll do this. In the live market, you have to constantly trade. You won't remember the strategies. You should know, it should come intuitively to you what to do, what not to do, right? So suppose if I created this strategy overnight in Reliance, my view is bullish. If Reliance falls, what will I do? Can I sell? Suppose Reliance comes to 1400. Can I sell 1500 call? But this won't be available at 68. This will be available at, for example, 45. Because if the market falls, this will also. So you can see my view was bullish, but I converted the same strategy, no loss on the downside. Is everyone getting it? So overnight, your payoff, your payoff should like always look like this, no matter what the stock is. Upside risk you can take, downside is always should be capped. If your view goes wrong, you can sell calls or options on the other side to manage the trade, right? It's clear, right? So if I'm having 10 lakh, how much money I must use for monthly return? See, as I said, what you will do is, first is if you have 10 lakhs, which means you can do only 5 lots, assume. So I would say one lot, do a bullish strategy like this. One lot, do a bearish strategy. Two lots, do a broken iron condor in Nifty, right? Okay. So that will discuss more in the money management. But is the concept clear and you can easily backtest? See, I don't want to like. I think this is the very simple, easy strategy to backtest. You can go home and backtest also yourself, but try to think how you can try to generate monthly income. So as I said, try to find out stocks which are bullish. Okay, create bullish strategies. Stocks which are bearish, create bearish strategies. Index, create sideways strategies with downside protected. If all view goes right, you'll make money in all. If not, then you have to manage, right? How, as I said, how you can manage in this, you know, the downside loss is capped. You can just sell a call option next day if it goes against you. If it's clear, I'll move forward. Jigar, specifically, like, does it make sense to you? So the goal is not to do all things in the index. Create a bullish strategy also like this, create a bearish strategy also, and create sideways broken in the index. Okay, so you're diversifying your risk also. Is it clear to everyone? And if anyone is doing anything else in the monthly, then also they can say. But it's the only thing like I could find out over years that like works consistently. Other like you have to take certain risk also to generate that monthly income. This is like kind of relatively, because anyways you are, if you're the stocks which you're selling put options, the stocks are already bullish and you're already selling it far away from the current market price. You are hedging it. If it goes wrong, you can sell a call. Same for the bearish, and for index you are anyways hedging the downside. Okay, so yeah, next let's move forward. Jigar, is it clear? Okay, so we discuss a monthly strategy. The goal in that is to, yeah. So I will be there in the WhatsApp group. We'll form a WhatsApp group after the session, and like that group will be there for life. So like I'll keep sharing strategies and whatever I see in the markets. Okay, yeah, I'll do that. But I'll only sell. I'll only share the hedge strategies. I won't share the risky ones. Yeah, I'll do that, Jigar. Okay, so let's move forward. So during all these 2 days, like last two, like today, yesterday and today, we were discussing about strategies and everything. But I would say as a trader, strategy is only 10 to 15%. What is more important is position sizing, money management, and risk management. In my thing, like these things will make decide whether you are successful as a trader or no. No matter how smart you are, how good your strategy is. If you screw up here, you cannot make money. So first thing is position sizing and money management. So what position sizing is basically knowing how much quantity to take before you take a trade. What people do is if they get a buy signal, buy Bank Nifty, they don't know any stop loss. They'll figure out what to do later. Sometimes they'll buy 10 lots, sometimes they'll buy one lot, right? No. So how will you proceed is first you calculate your total capital, and on a single trade you will never ever lose more than 1 or 2%. It depends on your risk appetite. You can 1%, 2%, even 0.5%. It depends on how you want to, how your risk is. On the basis of that, you will decide how much quantity to trade. Right. So capital is 1 lakh. 1%, for example, would be 1,000 rupees. So if you get a stock which is at 100, the stop loss is 595. So it's a 5 point stop loss, which means you can take 200 quantity. So no matter, so whatever, even if a setup looks good, even if you think it's very good probability, you will not risk more than 1% of your capital. Or if you think you can risk 2% also, but you should, does not mean you will buy 100 lots, 200 lots. So you should know before the trade what is your stop loss and how much you're willing to lose. Is it clear? So this I guess we discussed in back testing also. So before taking any trade, this is the first thing you have to change. Like for example, we discuss 100, the stop loss is 95. So you're buying 200 quantity. What if the stop loss is 99? How much quantity will you buy in this example? If you're buying at 100, your stop loss is 99, capital is 1 lakh. The risk per trade is 1%. Yes. So it's simple, right? So basically, your quantity will change on your stop loss. If your stop loss is small, your quantity will increase, but the risk is same for every trade, which means no matter what happens, you will not lose more than 1% of your capital. Is it fine? So sometimes what happens is the stop loss is very small. You can trade a big quantity also. Even if you go wrong, your stop loss is very small. The amount you want to lose is same, right? So this is one thing you should always keep in mind, no matter like how good you feel. So what happened when I started the markets, I used to trade with one lot if I found the setup is okay. But if I thought that the setup is good, I used to buy 10 lots. But that does not work because every trade is completely random. You don't know which trade will be successful as a system. As I said, back to back 8 losses can also be there, right? If you're trading 10 lots back to back 8 times, you will lose a lot of capital. So you have to make sure that risk management is in place, because you have to make sure that your system can even lose, right? So you have to keep your bets in a manner that you can again take a next trade. In a single trade, if you lose 20% of your capital, no matter how like you are very confident, but if something goes wrong, you won't be able to take the next trade, right? So this is very important, position sizing. So money management. So we were talking on money management, how to do money management. So what I do is, so my money is in FD. So that gives around 6 to 6.5% annually. On so I don't so on that money, I can trade options. So how does that? Basically, I create a, it's called a three-party FD between me, broker, and the exchange, right? So when that FD, so there's no haircut on the FD. So I get the entire money to trade markets. I just have to make sure that M2M settlement is done. Then I do some positional trading as I showed. So I target not even 2, 3, I target only 1 or 2% only, right? Then I do intraday trading. I try to generate 2 to 5%. And on mean reversion, I try to, like, it does not happen. But on an average, my target is to generate at least 4% a month. Sometimes I'm not able to generate. Sometimes I even like generate a lot more. So average, I try to generate 4%. And if you're trading derivatives, I would say 3% is something you should target, because you pay a lot of taxes. You are taking so much risk, and if after taking so much risk, you cannot generate 2 or 3% also consistently, does not make sense to be in the markets. See, as derivatives trader, we are taking so much risk, we are paying so much taxes, and if we cannot generate it, because even if you generate 3%, which is basically 36%, 30% will go in tax, and even more than that, you pay STT, you pay so many taxes. So you have to make sure that you at least generate 3% to 4% consistently. And we discuss how we can do that. So how are we using our money? So first, this money is generating 0.5% monthly for us. Okay. On the same money, we are trying to generate 1 or 2% monthly. We are not bringing new capital. The same money is being used twice. Again, intraday also we don't need money. Same money used again being used thrice. So basically, the return, if you see, even if you have 10 lakhs, basically you have 30 lakhs, right? And if you get leverage, even more. So the returns 3%, I'm saying it's on the capital, but on the margin, if you say it's very low. Does this make sense? Money management. It's basically how to use your capital effectively. So see, even if I keep the cash in my account instead of FD, I won't get the 6%, right? You pledge the positional options. Can you show an example in sheets? Okay, Rajesh, I'll show an example. No, I don't pledge the positional options. I'll show you what to do. Let me just show you in an Excel only. So assume capital is, suppose, see, minimum amount required to create an FD is 25 lakhs. 1000 lakh 25 lakhs. Okay. So return by FD monthly. Yeah, this is all monthly. Is it will be basically 0.5 into this divided by 100. I can make 12,500 rupees by FD if I put this money in a FD, right? Okay. Positional monthly income, 1.5 only. I can make 37,500 by this. Okay. Intraday, intraday we have a lot of strategies. We do directional. So intraday we do directional. We do uh, theta decay. We do expiry. So a lot of things. So overall, I'm saying you generate 3%. You can generate more, generate less, all depending on your leverage. So 3 into this by 100. Right. Net you make is not coming. Okay. Whatever it is. So basically it would be, yeah, which is basically 5% of your capital. Now does it make sense? So now if you again break this, 7,500 is for the month. For 7 divided by 22. For each day you want to generate only 3,500 points. If you divide by 20, lot size is 20. So basically, so basically 75,000 is for the entire month, right? So for each day it is approximately, so you use 10 lakhs for monthly, wait. No, see Abhishek, in India, I don't bring new capital for intraday. So for the entire 25 lakhs, I create monthly strategy. And intraday, you get leverage, right? I can convert the position into MIS and do intraday also on the same capital. I don't need to bring new capital, right? You can do this. So basically, that is basically 3,400 rupees daily, right? And if you have, for example, 20 lakhs, assume you can do 25 lots in Bank Nifty, right? So you can do 25 lots in Bank Nifty divided by 25. If I put FD and pledge, how much money can I get to trade? There's no haircut on FD, Rajeshi, but you need at least 25 lakhs FD. So can you convert MIS to get the capital for intraday? Do intraday, then convert? Yes, yes, service. Exactly. That's what we do. So we trade intra. So basically, what I do is FD is okay. If I don't do this FD, my yearly loss would be 1.8 lakhs. So why not to get this 1.8 lakhs if I'm getting it for free? I'm not taking any risk for that. Which broker? FD angel broking helps. Angel broking does provides. Zerodha is not doing it. Angel broking is doing it. Also, if you want, you can connect with Dhiren after the sessions. So basically, return by FD is then monthly income generating 1.5% is decent. You can, and then your skill extra income. This will decide how much you will make month. I'm assuming you make 3% a month. So average. Sometimes if you are good intraday, you can generate more also. If you try to generate more, 2%, this will also increase. But average, you should try it 4 to 5% monthly, right? by FD who is not doing intraday, only doing monthly. You're anyways beating him, right? He might be trying more returns on the monthly thing, but you are beating him and you're not taking more risk for this because monthly is already hedged. Intraday, you're already alert and doing as per your systems. And you want to only generate 10 points per day in Bank Nifty, which is very much easily possible. So sometimes this can go high, sometimes this can go low. So overall average, you can generate 4 to 5%, I'm saying. Easily possible. Right? Sometimes there might be losing days also, but this FD, this is guaranteed. This monthly also, you lose only on the intraday side if you don't do it properly, but it's fine. Like you can try to do this. Okay, so that's why before starting, first ask what you want from the market. Don't blindly start. Trading is a business. Like you have to treat it as a business. A lot of the people just come to the market because there's no barriers to entry. But you have to think in a smarter manner because see, you are competing with hedge funds, like people with lot of capital and lot of other power. So you have to think and be with them and be smart if you want to survive in the markets. Simple buy and sell won't make money. Is this clear? So if you're not doing it, start doing it. Try to generate, uh, like try to use the same capital multiple times without increasing your risk. If it's clear, then I'll move forward. Is it clear? Okay, yeah. So I'll move forward. So this is very important. Money management is very important. You have to like be smart in managing your money. You know what people do. You know why the Thursday expiry is on Thursday? Can anyone tell why does expiry happen on Thursday? Let me see what happened. No idea. No idea. T plus one. See, T plus one is right, but you. So why it happens on Fridays? So basically, there's settlement, right? So if the Thursday expiry is on Thursday, the money will come into your account by Friday, right? So basically, these derivatives, when we started, they were for big institutions, so which have big capital. So they don't like to keep their capital idle. So Monday to Friday, they're in the markets. Friday, they close the positions. Friday, Thursday, they close the positions. Friday, they get the money. But Saturday, one Sunday, markets are shut, right? So what they do is they keep the money in money market, which is called as call money. So they invest the money, and for 2 days they get return, Saturday and Sunday, because interest is there for every day, right? So basically, this it's something called a money market. You can read this online. Like I don't that. Is this clear? Like why was it? Why is it Saturday? Why the expiry happened on Thursday? Because expiries happen on Thursday because uh, the big people need to have the money and want to generate returns on weekend. How can, if expiries happens on Friday, they will get the money back on Saturday. In fact, Saturday it does not work, so they'll get money back on Monday. So if it happens on Thursday, they get the money on Friday. 2 days they can invest in the money market, get some returns, again take that money back. So see, on a bigger cap, on a small capital, it won't make sense. But if you are having 1,000 crores, getting some return for 2 days, 2 into 50, for 100 days, you are getting interest, which is very good, right? And you are doing both.
Is it clear to everyone? So I'll write an article also on this, like why does it happen, a detailed article. So yeah, so see, markets are designed majorly for big players. So that's why retail traders cannot make good quick money, or most of the people cannot make money in the markets, because the markets are designed in that manner that it will facilitate that those who are strong, like, try to dominate the market. So if you want to be successful, you have to think like them and you have to trade like them. Just I'll simple buy, I'll look a pattern and I'll buy a trade, I'll do a head and shoulder. It won't make money. You have to be smart, you have to diversify your risk, and you have to be smart with money management. Then only there's a chance of making money. Okay. So that's why we will invest in some liquid funds, or any other what, even some the brokers are pledging mutual funds also. So you can do that and try to generate, without increasing your risk, try to generate additional income. Okay. I have heard about Deepak. Yes, people invest in overnight funds also. Yes. See, people who have big capital, they don't like to keep it idle. They will invest even if they get any like XYZ amount. It is free money, right? It is free. Yeah, there are a lot of funds, there are a lot of different things. But what I do is, so basically I keep in FD. So basically the money is there always, and I am getting the money to use in the markets also. So the same money I'm using it twice. The only risk is I should not make much losses in the market. If I make much losses, they will break my FD. So for that, I keep some money as M2M settlement and I manage my risk. Clear? Yeah. So let's move forward. So we spoke about strategies, I think it's clear. Then we spoke about money management, which also I think it's clear. Now let's speak about risk management. Mean reversion system. I told you, Sandeep, in the start only we discussed, right? The pair trading thing, which I do. I'm not discussing it here because the trades are also less, and it is like you need an academic background, statistics background to understand the system. Oh no, same, it's same. Yeah. So risk management. Never risk more than 1 or 2% of your capital on a single trade. Have a risk of reward of 1:2 or 1:1.6, as we said yesterday. Never average a losing trade. So what I do is, as a risk management, for example, if I want to trade, for example, 100 lots of bank nifty. So what I'll do is I'll start only with 1/3 quantity, 33 lots. If I go right, I'll add more 33 lots. If I go right, I'll add the last quantity, which means I'm adding to my position only if I'm going right. So if I go wrong, I go wrong on the 1/3. But if I'm right, I'm right on the entire quantity. So in that case, my risk management is already taken care. See, as an intraday trader, you have to take chances. For example, assume, let's do this as an example. So here, so assume you have 25 lakhs capital. Your risk for the day is 1%, which is 25,000. Right? So you can risk 25,000. So does it mean you will risk this in in a single trade only? As a trader, you need to take chances, right? So you won't risk this in a single. Do is, so for example, it's 50,000. Okay. Suppose you're risking 2% a day. So you won't risk this in a single trade. So what you will do is, for example, you can do with 25 lakhs. Suppose you can do 25 lots of bank nifty. Suppose you can do 500 bank nifty, right? But if you do 500 bank nifty with a stop loss is 100 points. If you go wrong, you lose 50,000. So if you can do 500 quantity bank nifty, start with 100 quantity only. If you go wrong, stop loss is 100, you lose only. So quantity, stop loss, PNL. Trade. As a trader, you need to take chances, right? You don't know. So first you get a trade. trade number one. But you won't go all in. So you start with 500. 100 quantity, you can do 500, you start with 100 quantity. Stop loss is 100. If you go wrong, your loss is this into, you lose 10,000. Still you have 40,000 to take risk. Okay, let's do a second trade. Same trade, you again get 100 quantity. Scale in, scale out. Scale in, scale out is best. This is not lots. This is quantity. I'm saying these are not lots. Abhishek. If you want to see in Bank Nifty, you can trade only 125 lots in a single order. If you want to, so there will be some slippages. That's why there's something called a slicing. Like you always hit the best bid, and you like. So I think this is not applicable for you all. But you basically you have an execution algo which will always be at the best bid and will keep executing the trade slowly, slowly, slowly. Is it clear? If you trade huge quantities, you need execution algos also. Okay, so first trade you are already 1,000 points. Okay, it's fine. The day is still left, right? Second trade, you are making 70 points. Your stop. Suppose you're making 70 points. So now you are 70,000 profit, 7,000 profit. So now what you'll do is you'll add more quantity 100. But for example, if this trade goes wrong, you already on in 7,000 profit and you lose only in this trade. So which means you have to scale in, scale out. If you are right, you have to. So for example, suppose if you are wrong, you lost only minus 10,000. Suppose if you go right, so you add another 100, you get another 100 points in this. So you are 10,000. Again, you add 100. You also getting 100 points on this. So basically 10,000, 10,000. So which means when you're going wrong, you have a small quantity. When you're going right, you are increasing your quantity. So this is what is called as pyramiding, basically scaling in, scaling out. So you increase your quantity only when you are right. When you're not right, you don't increase. Is it clear? So this is also very important, like, because how you handle your losing trade is also very important, right? If you're wrong, you should have a small quantity. So what people do is they take only one trade a day out over. No, you know your risk limit, divide into 3 tranche. First trade, take that risk. Second, another take. Third, another take. Right. So if all are wrong, then that's not your day. When can we do if we are right in a single trade? Yes. So if you see, like, I don't know if you follow me on Twitter or no. Like I tweeted on, I think Bajaj Finance. I bought it from, I guess, 2050 to 2100. I kept buying it on every 5 or 10 rupees. I kept buying it because the trade was going in favor. I'll keep buying it. If the trade does not go in favor, I'll exit it. Right. So this is very important, like which you should do. So this is also a part of risk management, right? If you are right, you are having a big quantity. If you're wrong, you're having a small quantity. The quantity is as per your capital. Is this clear? Scaling in, scaling out. See, this will only decide how much money you make when you are right. As a trader, it is not making money. More money when right is more important than making money. So when you are right, you should keep increasing your quantity, right? But your risk is already diversified because you're already moving your stop loss up, right? So the initial trades are anyways at cost. Is this clear to everyone? Yeah, because this is also very important. Like most people take it lightly. I think this will separate you from other traders. Like following the same system, but doing this differently will decide how your results are, right? If you do this properly, so when you're right, you are having a higher quantity. When you're wrong, you're having a small quantity, which means even if your system is bad, like is giving a loss trade, but your loss is smaller than what the system would have told you because you had only small quantity. Clear? Okay, so let's move forward. one more important thing is always take a small loss. Like uh, this is, I would say, it's easier said than done. Like it looks easy, okay, I take a small loss, but when you're in the market, most of the people cannot take losses. That is the biggest reason I would say people like cannot succeed, because taking a loss is basically accepting you are wrong, which most people cannot do. So learn to take losses. It is very, very important. Like you should be able to take, as a trader, you will always have losses. No trader can say I'd never have a losing day. What is your opinion on capital equal to margin? No, no, 2% is on the capital, not on the leverage. Total capital. If you have 25 lakh capital, your risk per trade is 50,000. Leverage, because see, I get 40 times leverage. If I compute the leverage and then see, it will be very high as compared to my capital. So no, and don't think of leverage for the start. You should do leverage only once you're comfortable with trading. So first, everything is on your capital. So 1% on your capital, 2%. I would say start with 1% only, right? Once you get confidence, you can go to 2% and 2% in strategies which you think have good accuracy, right? So 2% you can go for the budget trade because the accuracy is good, right? Okay. So always learn to take a small loss. You should not okay, like, because it's very important to take a loss. Most of the people don't take a loss. I know people, when demonetization came, they shorted Nifty at 8,600 and they squared it off at 11,000, and they didn't even square it off. The broker squared it off, right? Crude, the recent example, crude. If you don't keep a stop loss, okay, you'll assume, okay, I'll buy at zero. What happens? Gone. So anything can happen anytime in the market. So never underestimate the markets. Always keep a stop loss and learn to take a loss. So if you follow system, you already know your max loss. If it that is it, exit, move on to another trade, right? Yeah, there's always another day, right? People get sad, okay, I have a loss. It's fine. There's one more day. So see, that will come only if you go through the emotional pain. See, I don't like to take losses because I have been through that emotional pain. So I don't want to go through the pain again. So now I don't like to take, like, I will keep my losses very small because I know what happens. I face a big loss. So I don't want to again go through it. So now it is naturally imbibed in me. Like I never takes the market lightly, and like I'm very quickly, I'll cut my position. If you see, I was short on Bajaj Finance. I felt it was going up. I exited the position. I went long. So I like to take chances, and I keep my losses at very minimum. So I don't see what happened in the past trade. Every trade is new for me. So this is very, like, this is something which I cannot like explain you. This is something which you will learn over time. But I can just emphasize that this is very important. No matter how smart you are, if you don't follow this, you won't make money. Is this clear? See, if someone who's been in the market for last 2 or 3 years, and if he has survived, he has done a very good job. See, demonetization happened, Nirmala Sitaraman happened, Brexit happened, surgical strike happened, crude thing happened, gap up, gap happened. So many things happened, and even one time you took the market slightly, flash crash happened. So many things keep happening, but you can survive only if you manage your risk, right? It does not mean that we did not have position on those days. As a trader, I always have a position, but sometimes due to risk management, we exit with a small loss or a big, whatever it is, as per our risk limit, right? So it's very important to always keep in mind that anything can happen in the market anytime. I remember one day it was 3:15, and so at 3:15 people are like, okay, the market is closing, they don't do anything. BPCL fell 10% in 2 minutes. So you take lightly, okay, our market is closing, what can happen? I told you the FII day, right? What happened at 3 after 3:15, 3:10? 1 rupee option become 100 rupee, right? If you take it lightly, gone. So see, so what happened is when I started the markets, so I learned something about pair trading. So it was a very basic system. So I started with one. So this is very long back ago. So I did it with like I think 5 or 6 years ago. So I used to do it with one lot. So I was making good money. So after in 3 trades I was up 40,000. I was like, this is a very good system. I found a holy grail. So because this always gives money. So next time I told my dad, because I only had very small capital. So I told my dad, okay, I want to take this trade. Please tell your broker to do it in a big quantity. So my dad said, okay, I'll do 30 lots. I was like, yeah. So basically, I had bought that. Pair trading was a very basic pair. Is the sound there? Oh, sorry. Is the voice there? Oh, yeah, that was the last thing I said. Is it there right? Yeah. So yeah, so what happened is when I started the markets. So when you start the markets, I learned something in technical analysis. I thought I can then using technical analysis I create a pair trading system. It was not basically a system, but something which I took 3 trades and I found out that in the last 3 trades it gave me good money, around 40,000. I was like, yeah, I was doing it one lot only. I was like, why not do it with a bigger quantity? I got greedy. So I told my dad, okay, now I want to do big quantity. So my dad was like, okay. So he did 30 lots. So I shorted HPCL and bought VPCL. But what happens is next day HPCL announced a dividend and HPCL gapped up 7% and BPCL gapped down 2%, which means the entire trade went into reverse. So that day it was a big loss, so I didn't take it. Next day I again saw HPCL is again going up, BPCL is not going up. So so 3 days I didn't take any trade. I was just watching the screen. I could not take trade. Fourth day I went online and started searching any bad news in HPCL coming. I went to the money control forum, start reading the comments, what people are saying. So when I was bearish on HPCL, so I was looking for people who would like to confirm my view. Okay, it will come down, it will come down. So next 18 days, 20 days, I didn't do anything. I was just looking at HPCL. My loss was increasing. At one point of time, there's a point where like you cannot take that loss beyond that. Like it's called an uncle point. So basically, when your any uncle comes to you and he twists your ear, at one point you'll bear the pain. After one point, you'll say, "Oh, uncle, stop." So at that point, I exit the trade. It was a big loss, but I learned so many things from that. Yeah, like so after that I read at least 10 books on pair trading. Then I figured out what I did was wrong. So basically I assumed the mean to be constant. So as the deviation was increasing, I thought it is deviating more, but the mean was also changing. So then I figured, then I read a lot of books, and then so it was a good learning for me. No matter I made a loss, but it was like actually that incident, like if that trade would have gone right, I next trade I would have done with a bigger quantity. So I think like it was a good learning for me. So I would say like, but you see for next 30 days I didn't do anything. I was just watching the screen. I couldn't react. So that is what you should avoid as a trader, and try to do all the mistakes when you are trading with a smaller capital. You cannot afford bigger mistakes when you're trading with a bigger capital, right? Yeah, so it's very important. So after that, that's why I'm not teaching you pair trading for that reason only, so that you also don't do such things. So that was a very basic system. After that, I learned a lot in pair trading. Like I completely built a statistical system only, which gives me clear entry and exit. So the important point is learn to take a small loss. If I would have taken the loss on the small first day and took some other trades for the next 30 days, at least I would have covered the losses, right? So this is the same thing happened. I didn't take a small loss, then I had to take the mother of all losses, the largest loss ever till that point of time, right? But luckily my father didn't say anything, so it's fine. So this is one thing, but see, it depends on your background. I come up from a business family, so that loss was still affordable for me. But if I was doing a job and if I had taken that taken that trade, it would have been a very significant loss for me. So it all depends what are your circumstances. But make sure that never ever take a very large loss. Always take small losses. It's fine. You can again come back next day, right? And one more thing, overnight everything should be hedged. Okay, so this I think we already discussed. So again what we discussed, you can again keep this in mind. What is your capital? What is the risk you want to trade? What instruments you want to trade? Yeah, theta. So theta is basically time. So you obviously need time, Sandeep. Yeah, so basically time is there, right? So we are exposed to market. Yeah, so you are already keeping stop loss, right? In every strategy, you are exposed to market. No strategy is risk free. Every strategy, there is a market risk. But the mitigating factor is the stop loss. Is it clear, Sandeep? See, whatever we discuss, everything is risky. Even the budget trade, no matter it has 100% accuracy, it is still risky. It's not, it will give you money every time. So risk is always there. Derivatives are definitely risky. Even in cash market is there's without risk. So anyone tells you there's risk, you can make money like money in the market risk free, please run. Like you cannot make money without risk. You have to take risk, but you have to take smart risk. You have to be the casino. You're not gambling, right? You're doing so much analysis. That's why you trade like you are in the markets. You have to think like a casino. So we discussed this, how to create a trading plan. Every setup will have different logic, different characteristic, different trailing style, different exit plans. Tools I already. So, see, a trade can have four outcomes, right? It can give you big profit, small loss, and big loss. So you just have to focus on avoiding the big loss. If you can avoid that, then you can succeed as a trader. So no matter how good you think market is looking, what people do is they have a stop loss of 100, but if market falls 150 points, they say I think kal jayega, we'll carry the trade. No, take the loss again, buy it tomorrow, right? So this is very important. Always avoid a big loss. So what I try to do is first is no forced trades. Don't try to do any forced trading just because you're front of the swing. You don't have to press any button. It's fine. Some days you don't do any trades only. Second, don't take it. Most people what they do is they're very impatient, not getting any setup. Let's do anything. Let's just short bank nifty. Let's buy bank nifty. It happens, right? How many people do it? Getting no setup, randomly taking any trade. You'll do it, right? Yeah. So it's human nature, right? Because you have to do something, else you'll feel like you are not a trader. What are you doing? Just staring in front of the screen, right? To make you feel that you're working, you have to press a button, right? Yeah, if you don't press a button, you'll think I didn't work only today. Right? So that's why avoid forced trades. Only trade trades as per your systems. Avoid big losses and ride the trend as long as possible. So as I said, that's why when I buy a future, I sell a call because I'm lowering my delta, but I'm still riding the trend. Because when you are right, you want to win more, and when you're wrong, you want to lose less, right? So that is important. So these four things keep in mind. Don't do any forced trades. Avoid big losses. As I said, money is made in spurts in trading. I'm saying 5%, 5%, 5%. But it will happen 1 month, you will get -2. But in 1 month, you'll get 12, 15% also, right? So it is in spurts. See, trading is not a business where you will get fixed monthly. Okay, I'll give you fixed 5% monthly every month. No. 1 month you can get even 50%, and next 5 months you won't get anything. But we are doing system trading. That's why we can at least generate some certain amount of money every month, but the variation will still be there. You don't know which month the system will work, which month the system will not. That's why we are doing different systems so that the drawdown is minimum. So no forced trades, no big losses. Try to be with the trend as long as possible because your goal is not to make money. Your goal is to make big money when right and lose less when wrong. And how do you ensure that is pyramiding? When you're right, keep betting more. When you're wrong, keep losing less. How many of you all play poker? Yeah. So see, trading is very much similar to poker. So in trading, what we do, when we don't have a good hand, we'll just keep check, right? When you have a good hand, then only we'll bet. So which means when you have a good probability, good setup of winning, then only you bet. Else you'll just keep, for example, the big blind, small blind, you'll keep giving. That is your stop loss, assume. You'll keep giving the stop losses, but you want a one big hand. So similar to trading only, right? Yeah, Texas only. Basically, poker is similar. So basically, I play poker almost every day on an app. So because if you play poker, so in poker also, so it happens is like, see, if you're not disciplined in life, you cannot be disciplined in trading. So if I play poker, I make sure that I bet only if I get a good hand. Sometimes I'm frustrated also, but I'll keep just folding. So it's sometimes after 1 hour I don't bet only. I just keep losing the small blind, big blind every time. But it is important because that gives you the patience, like not to go all in because you're frustrated, right? And those who don't know poker, they can start learning poker. Like I think that helps in psychology. So basically, it helps you bet only when you are right and when you're and not to and the rest of the time just be in the trade. So the rest of the time you're in the markets, but when you get a chance, you bet. So keep these 4 things in mind. No force. So win more when right and lose. Okay. One more thing in risk management. See, I showed you Raj's portfolio, right? It is 90% down. Yes, bank. So, see, when a stock is down 90%, it does not have to go up 90% to break even. It has to now go 900% up. So always keep this in mind. A stock down 50% has to go up 100% to break even. So which means if your capital is down 50%, you have to make 100% return to break even. Right? So if this is smaller, it's fine. If it's 10%, it's only 11% you need. That's why I try to keep it within 20% of drawdown. Most people ignore this. A stock down 97% has to become 32 times just to break even. And how much time does it take for a stock to like go up 32 times in years, right? So for Yes Bank, Tata Motors to come to those level, it would take time, right? So you lost compounding, you lost lot of, so you lost your capital, you lost your time also. How to calculate this is simple. Like I think there's no calculation. It's very simple, right? It's intuitive, right? Does anyone do the calculation? I think you can do it, right? If you buy a stock at 100, it comes to 90. How much percentage do you need if it has to go back to 100, right? Yeah, so Ashish was giving formula. I think it is intuitive. You don't even need a formula. You can like do it, right? So always keep this in mind. That's why always try to keep your portfolio loss under 20%. See, 20% you need only 25%, which is still possible. But as soon as the loss of the portfolio increases, it will take time to break even. So what happens with most traders is, for example, they lose 50% of capital, right? So now 1 year or 2 year would go just to break even, which means as a trader for 2 years, you did not generate any income. And when you're at a 50% loss, no matter how good systems are, you don't have the psychology to trade, right? So it is very important to keep your losses under 20%, portfolio level loss. Your portfolio loss, even 20%, I would say, is high. Try to keep it as low as possible. That's why, like, try to mitigate your risk. Try to bet small. Bet more only when you're right, right? So see, what does it say? The key to trading is emotional disciplines. If intelligence were the key, a lot of people would be making money, right? So if it was only about intelligence, all algos would be making money. But to be disciplined, like having an edge, that is more important than anything else. So you need to have that psychology, and psychology will come with time. You should read this book, Trading in the Zone, by Mark Douglas. It's a very good book on trading psychology. Has anyone read it? Okay, so I'll share the book link. So try to read it. See, as a trader, you have to develop your psychology. You should be immune to losses and immune to profits. Does not mean if you're making good profit, you start celebrating. If you're making losses, you become sad. You should be immune to it. No matter if it's a profit or loss, your family shouldn't know you made a loss or profit today. Yeah, I'll send all the books. Okay. So it is very important, but this will take time. It takes time, but with time, you should like be immune to profits and losses. Does not mean if you're making good profit, you'll exit. Arey, okay, aaj ka ho gaya. No, be with that. Who knows what is the maximum profit, right? So yeah, there are no stock market geniuses. You just have to be in control of your emotions. So this is what market cycles look like. So it's difficult to quantify which area market is, but this is what most stocks do. I don't know where we are currently. Are we in panic, capitulation, anger, or depression? I don't know. But nothing that can be quantified. But this is generally what happens in most stocks. So okay, so that's why be your own expert. So you can see Yes Bank target 300 by Philip Capital when the price was 222. F14 2019. What happened to Yes Bank? 90% down. A lot of people are buying Yes Bank saying that it is a value buy, value buy, value buy. But what happened? You lost 90% of your capital. Orange is a famous small cap investor. He also lost 40% of his wealth. So that's why I say market is the supreme. You have to exit with a stop loss. Yeah. In case of Orange, so he's a good investor, but what happened is all his investments are small cap companies. So now if he's selling the stocks, it is hitting lower circuits. So he cannot even exit the stocks because there is no liquidity. So that's why there are no experts in the market. That's why I only trust myself. I always like once I do the analysis, I don't look what people are saying because I can change my view also very quickly. That's why I don't watch any news when I'm in the markets, because if I watch news, I will like have some notions about the market. So as I said, everything is there in the price. Simple. A stock is bullish if it is going up. A stock is bad if it is going down. You have to know this. That's why like I don't watch any news. Oh no, yeah, I am just aware what events are going to happen that can affect my investment. So there's a blog on I have written on Medium, what on my daily like what I do daily. If you all want, I'll share it with you all. So news I only like to keep a tab which can affect my investment. For example, if Fed meet is there, okay, it can move the markets. But during the markets, when I'm trading, I don't like to watch news to see okay what to do, what not to do. Okay, Sarvesh. So I don't get trading ideas from news. I just keep news to see how it can affect the market. Okay, yeah. So people say too big to fail. In India, which company is too big to fail? Yes, HDFC Bank. I think Reliance also. Yeah. So this is a story about a fund, hedge fund called Long Term Capital Management, and the name is ironical because the name is long term, but they closed in 3 years. So what happened is this fund was started by Nobel Prize winners, and the model we still use it. Black-Scholes model was given by them. So these guys are making good money, very good money. In fact, they were making so much money that all the big investment banks in US were giving them funds to manage our funds and give us the return. So they were like, okay. So they were doing very good for 1, 2, 3 years. They did very good. But what happened is, so basically they were running a mean reversion system, buying one, selling another. So what happened is in that time, there was some crisis in Asia. So yeah, so yeah, exactly. So there was some crisis. So what they did is, so they, so as I said, so as crises were happening, they kept increasing their position. They kept increasing because they thought it will again revert back. Again revert back. But what happened is the position went so big and the reversion didn't happen, that just to keep the position open, they had to inject more money, more money. But the position was so big that they had to eventually close the trade, and they lost a lot of money. In fact, they lost so much money that the Fed had to come to bail them out, because if the Fed didn't come, the banks would have failed because the banks had given them capital. So what does this tell you is that no matter, even if you're a Nobel Prize winner, you can go wrong. But they could have survived if they had done a risk management. But there was no risk management, right? Because see, with knowledge, there comes arrogance also, right? I am a Nobel Prize winner, I cannot go wrong. So you should take this as a learning and say, no matter, even if you are very smart, a genius, still you have to manage your risk, because anything can happen. For example, crude, you would have bought, who would have thought that it could go to negative? Like no one had even heard negative prices before, right? So which means risk management is very important. And due to the crude episode, a lot of brokers lost money. Zero lost 10 crores, Angel Broking lost 13 crores, right? So it's a systematic risk. So that's why you have to manage your risk always, no matter what you do. So which means anything can happen anytime. So that's why you have to manage your risk. See, a lot of people, when they come to the market, they buy a stock because they, what is the hypothesis, or kitna girega, right? Now it has changed to yes bank lu kiya. So this, if you are in from the market, most of the people from your family will ask you, okay, और कितना गिरेगा? Tata Motors at 400 कम, और ले लूं क्या, और कितना गिरेगा? 300 again then कम, अरे इससे ज़्यादा क्या जाएगा? Tata Motors 200 again, 100, right? But let me give you some perspective. This is Jet Airways. At one point of time, it was the largest commercial airline in India. Market share 22%. What happened? Went to zero, right? And they say, और कितना गिरेगा? So the lower limit is zero, and now we cannot even say zero because prices even go into negative, right? So basically, from 830 it went to 0 rupees. But at one point, it was largest commercial airline. So which means anything can happen anytime to any stock. Arcom went to zero. And you know what happened when Arcom was listed in 2008? Uh, at 2006 or 2000, like just before the crash, people were saying that Dhirubhai Ambani company, you are getting in 3 digits. ऐसा भाव कभी देखने नहीं मिलेगा. And actually वापस कभी देखने मिला नहीं. So see, but you think this is funny, but if you see at one point on, this is a Dhirubhai Ambani company, right? The richest man in the country. How can it default? But what happened? It went to zero. Satyam. The Satyam scam, everyone remembers. So it also fell a lot. But 2 years before the scam or 1 year, I don't know the exact date, it won a Golden Peacock Award for best corporate governance, but it did the biggest corporate fraud in India. That's which means don't go on awards. So globally, see, Coke topped out in 1973 and declined 70% and took 11 years to break even. Amazon fell 90% during the dot-com crash. General Motors went to zero. Lehman Brothers, 200-year-old company, went bankrupt. AIG, Enron, WorldCom all went bankrupt. So what does this tell you? Anything can happen. Anything can happen to any company. You can only manage your risk. That's it. And this is the only reason, due to so much analysis, that's why I first give preferences to my systems and then I follow fundamentals. I'm not against fundamentals, but good companies can also fail 90%. Right? Amazon fell 90%. It does not mean if it's a good company, it cannot fall. You can only survive all such things, and this will keep happening. Does not mean it won't happen in the future. Crashes will keep happening. If you're in the market, you have to embrace it. Crashes will keep happening, depressions, recessions, everything will keep coming. But you can only survive if you manage your risk, right? Does this give you a good perspective, like not to trust a company blindly? Always keep a stop loss, no matter how blue chip the company is. Even HDFC Bank for that matter, or even Reliance, right? Always keep a stop loss. Yeah, no matter how good the company is, because you don't know what can happen anytime. So as they say, see, without data, you are just a person with an opinion. So whatever you do, always have data for it. So when I say that I don't believe in fundamentals, people argue with it. I tell them, okay, give me a proof that fundamentals like value investing works. See, if you give me proof, I'm open. Like I want to hear your counter views also, but you should follow data. Whatever it is, whatever you do, everything. And as time, like in current times, when we have so much data with machine learning, artificial intelligence, we can utilize it to even make smarter decisions. As a trader, you should always look at data and then make your trading decisions. Yes. So I think we are end with it. So now just to give again to like say that whatever we discussed, like we must just have discussed some names, but don't take it as an opinion. It could be Asian Paint, HUL, Alembic. Don't take it as a recommendation. As I said, anything can happen to any company anytime. That's why, see, whenever people ask me which stocks to buy, I never tell them, because if I tell them okay, exit in a loss, they won't exit only. I know it. So I don't tell only which stocks to buy, and they think like I don't tell because see, I can exit a trade in a loss, but and I know what position sizing to take. They can go all in and they'll buy all the like whatever money they have. That's why I don't recommend stocks to anyone. First of all, there's no holy grail system in the world, no matter how smart you are. So only holy grail is risk management and money management. And there's no such thing called as risk-free investing. Like everything comes with a fair amount of risk. You have to see, is the reward worth the risk? So in trading, trading is all about taking smart risk. You have to think like a casino, but you have to see like what the risk you are taking. Are you being compensated equally? Right? As I said, think in terms of R. To make this much R, how much risk are you taking? Right? I'll share one more thing. This is also very important. So before you take a trade, what instrument are you trading? What are you doing? What is your logic? What is the quantity you want to trade? I type is basically option of futures. What is my entry price? What is my stop loss? So if you see in terms of this, I know my R, right? What is the exit price? What is the risk to reward? What was the exit logic? Did I exit because I was making money? Did I exit because the stop loss was hit? How much point did you make? Net PNL with charges. You can, so I've written a formula for it, like using the Zerodha thing calculator, brokerage calculator. What did you learn anything from this trade? Every week again go through this, whatever the learnings are here. So what I do, all the learnings I again put it here, right? See, if you do this over years, you'll become a smart trader. You know, you won't do the same mistakes again and again, right? Is it clear? You see, there's so many things like which I observed, like I keep noting it here. Yeah, I'll do that. Sarvesh. So yeah. So as a trader, if you want to be successful, after every trade, update this. Think why you went right. Can you replicate it again? If you went wrong, can you avoid it again? And every Saturday, Sunday for 1 hour, again go through it, note in learnings. Next time, okay, you'll obviously keep learning something new. Next time you'll again optimize it, right? So I have my so I gave you a framework for certain strategies. You can observe certain things, you can again optimize it, right? But you have to keep doing this. See, trading, it's not about just buy and sell. If you think buying and selling can do it, like anyone can do buy and sell, but trading is much more than that. So once you build your systems, when you take a trade, always maintain this journal and do it strategy wise, so that you know where how each strategy is doing. And whatever you note, so I have a trade book for expiry, some everything is like for every other trades strategies. And once you note the learnings, keep it, like put it somewhere else, and make sure that next time you don't repeat the same mistake. So with time, like for example, after 1 year you will have a lot of learnings. You It's okay if you make mistakes, but you'll learn a lot of things, and you want that next time you don't repeat those mistakes. So as I said, as a good trader, you should know why your winners are winners and why your losers are losers. So you want to replicate the same thing with the winning trades and want to avoid the things you did with the losing trades. See, market is all about patterns, and the patterns keep on repeating. Your goal is to just find out patterns which work and patterns which do not work. Is it clear? Yeah, so this is also equally important. So what I'll do is I'll share some books. I'll share this trade journal. I'll share the learnings. I'll give the access to the video also, but the access to the video will be only for a week. So if you want to revise, you can again revise, and after 1 week, the access won't be there. The notes you have, the notes you can refer the notes also. And from all the strategies discussed, it could be that you cannot trade all the strategies. So you have to figure out what strategy works for you, what you want to trade as per your risk appetite, as per your capital. So think over it. That is more important. Like what do you want from the market, as I said, right? And give like a lot of importance to risk management and money management. Okay. Yeah. Yeah. So basically, yeah, you should like take 1% risk only in a single trade. Yes. Why 1% risk? Because if you go wrong back to back 10 times, you will lose 10% of your capital, right? But if you trade like with, for example, with 1 lakh, you take the same trade, you will lose 30% of your capital. Is it clear, Abhishek? Yeah. So that is important. So I'll just see what we did today again. Basically, today we saw what market opens within previous day range. It's a good time to create short triangles or short straddles. This was something which we discussed, like how to manage the trade. This is slightly discretionary and to be done only if you have good knowledge and on options adjustments. You can skip, but you learn. I'll share my trade log as whenever I do these trades so that you can understand these better. The C you can do whenever it happens, you can create a straddle with a stop loss. This we discussed Wednesday strategy. We try to find out the mode, sell options, and instead of selling naked, we create spreads, credit spreads, and carry the position. Expiry trade is kind of similar to intraday trading bank nifty, but you build your position size very slowly and you do it the entire day and exit by 2:30 p.m. to avoid the risk involved. There are times when you should buy options is whenever there is unwinding in the maximum call OI, put OI in the last half of the expiry, last week of the expiry, because the gamma is always with you and all the option writers could be trapped. Then we discussed position sizing and money management. I think this is equally important and I would say even more important. So you should, no matter how good your setup is, no matter how convinced you are, keep your loss per trade defined, right? What you can do is you can add more if your trade is going in your favor, which is called pyramiding or scaling in. But you need to be smart with money management. So instead of keeping your funds idle, you can keep in an FD. But that is possible if you have a bigger capital. If not, then you can keep in stocks, blue chip stocks or mutual funds and pledge it. On that, you can do positional trading to generate certain income. And majority income you can generate doing intraday trading. You have to see which, as per your circumstances, what all is possible for you. Some people cannot do intraday because they have some restriction. So you have to see what you want to do. So never risk more than 1 or 2%. Always have a good risk to reward. So always think in terms of R, as I said, and never average a losing trade. So you have to bet more only when you're going right. If you're going wrong, always 1/3 position size, and follow your plan consistently. So think over this before starting trading, like what all things you want to do, what all instruments you want to trade, right? Always avoid a big loss no matter what, and I cannot emphasize the importance of this. So this is very easier, it is easier said than done, but it is equally important and very importantly, you should always avoid a big loss. So don't take forced trades. If you're not getting any setup, it's fine. Avoid big losses, ride the trend as long as possible. This is for directional, right? Don't do this in theta decay. In theta decay, you have to exit if you're getting profit, because theta decay is a different system, and win more when right and lose less when wrong, right? So always keep this in mind, that why you should always keep your loss under 20%, because you need to generate much higher percentage to break even. So if you are at a 50% drawdown, you have to generate 100% drawdown to break even. So which is emotionally also challenging. Lot of time is also required, and it will affect your psychology as a trader. Yeah, that's why like try to cut your losses very quickly. So yeah, so anything can happen anytime to any company. So you can only survive if you have proper risk management, no matter how good the company is. And always believe in data, always trust data. Whatever you do, properly backtest, properly have data proof, and then only trade or invest. And trading or investing has risk involved. So definitely, like whatever you do, you have to make sure that it should be as per your circumstances. For someone, 10,000 loss could be too much, but for someone 10,000 loss could be nothing. So to make sure and do proper risk management before doing any trade or any investment also, right? And there's nothing which is a holy grail in the markets. All you can do is manage your risk and manage your money wisely. So I think this is it, like what I wanted to cover. So now I think like anyone has any questions, I'll take that. I'll share the learnings. I'll share this PDF, both the PDFs. I'll share the trade journal. I'll share the video access for a month. And yeah, someone Deepak had told me to show eye chart, so I'll show that.
Hey, Saurabh, just I had one doubt.
Yeah.
So basically, this thing I told, right? One lot of Bank Nifty and max loss of 3,000. For example, let's take Bank Nifty only we get trades like 7-8 times a month. So I have one more strategy which for example, I have one strategy which is in stocks, and it gives like maybe average 2 trades per day. So then also, should I be keeping 3 lakhs as capital, or should I be keeping more than 3 lakhs? Like I think you must have understand the case, right? Understood the
No,
case.
no. Yeah, Deepak, I'll show you. Yeah, again, can you explain?
Yeah, so basically, as I said, like if we are trading one lot of Bank Nifty and it has a max loss of 3,000, we take capital as 3 lakhs. But additionally, there is one more strategy, which so this Bank Nifty strategy only like the system trades maybe 4 or 5 times a month, or for not for 7 or 8 times a month. And additionally, we add a strategy of stocks which maybe gives out averagely three stocks per day or 4 stocks per day. So should we trade with the 3 lakhs, or should we have additional capital for the other strategy?
No, no. So what you can do is, when I say 1% per trade, basically I mean 1% a day. So what you
Okay.
can do, for example, for that day, if you already have profits, which means you, for example, if you are already, for example, you have 10 lakh capital, you already on 10,000 profits. But so as per 10,000, 1% risk is basically minus 10,000, right? You can,
Yeah.
so you still have 20,000 cushion, right? So you can take the trade. So what I mean is, so as I said, in money management, what we are doing, we are the same money is into moving into different strategies, but you have to make sure that your loss for the day is defined. So your loss for the day should not exceed 1 or 2% of your capital. So even if you like, it's not like, so if you're doing an intraday strategy, right? And so you don't have to
Yeah.
bring new capital to trade the Bank Nifty thing, but you have to make sure, for example, if you're at zero profit for the day, so to make sure you take Bank Nifty in such a manner and the open position in another system in such a manner that if both the stop losses are hit, you lose only 1% of your capital. Is it clear?
Yeah, yeah, got it. Thanks.
Yeah, Deepak, I'll show you. Let me just take, like, if anyone has any questions. For weekly, what percentage of capital you use on weekly intraday, right? You mean? So Friday, I like generally I trade very light. Majority is on Tuesday and Wednesday. So Friday, Monday, I generally try to find directional setup. Tuesday, Wednesday, Thursday, I generally like to like trade like mostly index only. So I would say 20% on Friday and 30% on Monday. Like, but most of the things on Friday and Monday, I like to look for, like, try to look for directional setups if I get. Is it clear? Directionally may or be, yeah. So I said, no forced trades. No opportunity means no trades. See, if I get the opportunity, then you can take a trade. So if you think that even if it's a Friday, but you see that the combined triangle is going down, it's below VWAP, hitting day low, you can take a trade. Right, Sandeep? Same, no position, no trade. So what I do is I try to create triangle, but I do it with a smaller, like less position size. Yeah, it can be applied to Nifty also. Hello. With reference to morning discussion in the no, so on expiry day, I don't try to keep stop loss on other orders, right? Because the gamma risk is too high. So I keep the stop loss on the sold option only. 30 rupees option you're selling, you can keep a stop loss on 75. You can keep OTM option also by, so you can, it's not, you shouldn't, but see, you have to manage your risk also if you do that. So you can the iron fly also. But what happens is on expiry due to the gamma, you're already selling option at 30, right? But if you buy another option at 70, basically you are net into debit, right? But on other days, that does not happen. Is everyone getting buy, not to buy? See, if you're selling option at 30 rupees and you're keeping a stop loss order at another option at 75, you have got a credit of 60, you have bought an option for 75. Basically, you're on debit of 15 points.
Hello, Saurabh. Pushpinder here.
Yeah.
Yeah, my
Yeah.
question is this. Let's say I have written two stranders. I got a 30 ka premium. Okay. Now
Yeah.
I initially kept each leg 75 as a hard stop loss.
Yeah.
Okay. Now let's say if I've sold 30 ka option, then let's say my hard stop loss buy would be at a strike at least 200 strikes, 200 point strike down. That option at that time price would be something like less than 10 rupees.
Yeah.
So I want to ask, let's say when my 30 goes to 75, my stop loss comes in this sold option. But let's say, should I use this as a stop loss, or should I say no? Let me use my iron fly. My iron fly buy should get striked in. If that, then on that 10, at what level should I keep on that stop loss?
So yeah. So
This is
if it's
only
for
for
example,
expiry. Weekdays I understood when premiums are high. So that part I got it.
what you can do is, for example, the option buy, you can keep a stop loss about the VWAP or the 20 SMA, right? So, for example, the 10 rupee option, whatever the price is above the VWAP or SMA, 20 SMA, you can keep the stop loss. But on expiry day, see, even if it gets triggered, right, you have to again exit it quickly because you don't want to give that time value. So, that's why I said in expiry, you build your positions. Am I audible? Yeah, sorry, actually, I was connected on the hotspot and the phone battery got off. Yeah. So what I was saying is, yeah, Pushpendra. So basically, see in so if you are selling option at 30 rupees, right? So there are two options. Either you can keep a stop loss on the sold option. So suppose you are keeping a stop loss at 70 or 75. By the time the 75 is hit, what you'll do is you'll keep, so for example, the 30 rupees becomes 40 rupees. So you'll exit the other side 30 and sell another option at 40. The 30 becomes 50, you'll exit the option, you'll sell another option at 50, right? So by the time your stop loss is hit, you must have got some credit. Or you can, as you said, you can do the protection orders, the iron fly at above the VWAP in the individual option. You can do both. But on expiry day, I generally like to keep stop loss on the sold option, then I try to adjust. Like I try to get premium from other side. Is it clear, Pushpendra? And that will discuss also, like when I'll share the trade log, and like this will take time also, like, to understand properly. Anyone, any other questions? Yeah, so the pivot system, I have backtest in futures only. The pivot system is on futures only. So that is a, like you would buy with a stop loss. But most of the time I like to trade options only because options gives an edge, right? And the main skill is managing the trade. Like as I said, you buy, if the trade goes in favor, you sell a call, you cap your profits, right? How to use Python and ML to enhance trading capabilities. So basically, Python helps you in back testing. So see, if you are doing manually, right? If I tell you to manually test even a simple strategy such as buy above R1, so there are so many stocks. You'll go individually to each and every stock for 5 years. You have to go minute by charts. You'll note the trade. It will take you a lot of time. But in Python, you can just write a simple code and it will be, the back test will be done for all stocks. But Python also, like, it requires some skills to learn, and it's not easy as like if you are not from tech background, it will take some time, but you have to give the effort, like you have to give time to it to learn. So basically the benefit of Python is that it will help you, like there are a lot of things. For example, if I show you the budget trade, right, the minute by minute how bank nifty moved manually, how could I have done it? It was very difficult. But if I could do it very quickly in Python, right? And ML is basically, ML can be used to, I would say, to enhance what you are already doing. For example, can I use ML to find out what is the best time to enter, what is the best time to exit? But ML itself is a very vast concept in itself. But basically the purpose of Python is to simplify what, like as a trader could, like as a normal doing in Excel could take you even months, you can do it in like a day or even minutes. To understand apart from backtesting, it's in the role of Python. So let me show you. When I say we need data, right? So to analyze the data, you need something. So if you see this, right? So this entire thing is built in Python only, right? But see, you need data, right? So as I said, the purpose of Python is, for example, if I show you this backtest, what is it doing is, I just have to change the entry logic, exit logic. It will automatically create this report, this trade. So I can just put a filter, show me systems only which have drawdown less than 10%, less than 15%, system which have back to back losses less than 8, less than 6. So if you do it manually, you can imagine how much time will it take, right? And the purpose of Python is to ability to backtest your hypothesis very quickly. So definitely it's a very good skill to have. Like it will give you an advantage if you have it. And even if you don't, like I think, like if you are back, you can like put some time and manually backtest strategy. So this entire thing is built in Python. But Python gives me the ability, the flexibility to backtest my ideas or test whatever I want to do very quickly, right? So if you see, what I did is I created different market types. So when I test a strategy, I
test across market types. I can do it because like so in Python it is very easy to do it, right? And one more thing is, for example, if I want to build a system, so there's something called as, so see what we were discussing, right? Marubozu, like candlesticks, right? See, there are a lot of names for the closing Marubozu. I don't have to remember it. I don't have to write the code also for it. There's already libraries which are already there. I just have to reuse it. So Python has good support for that also. So if you can see that in this, we basically use TLib only. So you can see like this homing pigeon. We didn't write the code for it. We just reused it from here. And there's good backtesting support also. There's something called back trader. You can see that a lot of things required for backtesting. So this is slightly complicated because it involves object-oriented programming. But basically, we can do all this in Python very quickly, which a normal trader would require. Like he would require months, I would require a day, but not even a day. So it takes me very less time to backtest a strategy. Is it clear, Pushpinder? See, if you don't have a tech background, it's fine. Like it's not required. As a trader, it's not required. But with time, you have to like, that's why maintain your trade journal very properly and try to learn from that only. But if you know Python, definitely you generate some additional insights, which like other traders cannot. Is it clear? Okay. Anyone, anything else? Yeah, Deepak, I'll show the eye chart. Sarvesh, like you are in another league only. But yeah, if someone from a non-tech background, I would say you can start with this course on Udemy. It's a this Python for finance and algo trading. So I think the course is not expensive also. You can take that course, start learning on your own if you don't know Python, or there are a lot of resources online. But coding requires effort. Like you have to sit on it initially. You'll have to decode bugs. A lot of bugs will come, but you have to invest the time. It's like learning any another new skill. Can we share intraday strangling group from tomorrow? No, intraday strangle. I basically am not doing much intraday strangle these days because the premiums are too low. But I'll share whatever setups I feel is worth sharing. So I'll keep sharing something every day. Yes, Pushpina, you can. But see, EOD data, you can test only EOD strategies. But what if your strategy is intraday? So for that, you need minute by minute data also. Minute by minute data is expensive. If you take from the exchange, that is even 25 lakhs. So it depends. Like, see, it's all depends on your use case. So we purchase the data because we actually required for back testing. Yeah, Pushpinda, you can like get it done from anyone who knows Python. Clear, Pushpindra? I'll just show you eye charts. So see, I use eye charts because my basic purpose is to create triangles and see what the triangle is doing. So I use eye charts. So what it is basically, you load the instrument, expiry date, you want to sell and see what. First thing, it should be below VWAP. It should be near to the day low, right? So that's when I try to create these options. I try to create these triangles. Other than that, in eye charts, you get this also. So if you are not getting any setups, you can look at this and see if any of the patterns we discussed are on these stocks, right? And you can use it for monitoring the OI, what is happening to the OI, for the max OI built up and max
I'll share the Telegram link with you all. So in that you can see it gives you a snapshot of that OI chain every time, and we are also building it. So I think it should be done, and as soon as it's done, I'll share it with you. Other than that, so I basically use this straddle charts as per I wanted. You can chart also. So you can add all the legs and create it, but I don't use it much. I generally use it for that only. And HVIP and other things are also coming. And for strategy building, payout diagram also coming. But if till that time you can use define it, that is free. Obstra. So basically, this is what I use for. So basically, I only use for straddle charts only. Okay. For sure, we have to subscribe, Avishar. Yes, you can subscribe if you are trading index very frequently. So I do it because I don't know what is the fees also. Let us see. Okay. So yearly it's 5,700, which is basically 500 a month. I would say equivalent to the brokerage you pay. So like very less compared to the brokerage most of us will pay. So the cost is not that much if you are trading index very frequently, right? And they'll keep adding new things also. So this is the only thing which I found in the markets currently. The other things are not as great as this eye chart. So basically, my main purpose is to use for this. Okay. Yes. What leverage one should take on 10x? I would not suggest. See, leverage you can take only if you are good at trading. But leverage is a double-edged sword, right? You can make more money, you can lose less, you can lose also, right? So I would say take only 3x leverage in the start. As you get confidence, try to increase the leverage. But in the start, only take 3x, which means with 1 lakh, sell only 3 lots for intraday. Don't take much leverage in the start. Clear? So angel broking provides 10x, but avoid taking 10x. Leverage you can take once you are comfortable with the strategy. Once you're expiring, as I said, it's already risky, and with leverage, it's more risky. So I don't think you'll require any tools. Eye charts, if someone wants to, they can. If they are trading the index extensively, if not, then I think even that is not required. Other than that, I'll share the learnings. I'll share the trade book. I'll share the video access for a week, and I'll share the notes. You can go through it again, revise again, think what works for you, what you think can be used as per your risk appetite. How many lots you trade? I trade approx 500 lots. It depends. So it depends how it's not a fixed number. I can trade. I can trade up to 1,000 lots. So it depends. So an expiry day up to 1,000 lots. Normal days around 300 lots. So it depends. Now I'm trading very lesser quantity because nowadays the risk is high. The premiums are less. So why to take such a huge risk? Right? See, so don't look at the M2M of anyone because see, you don't know how much risk they are taking to generate that money. Just focus on your trading. Just focus what you think works for you and start small and gradually build over it. So it does not mean I have been trading 300 lot, 500 lot from day one. I started with 5 lots only. With time, with confidence, I started increasing my quantities. Any idea how algo trades BNF options? Basically, algo is just a fancy term. Basically, algo have buy orders and sell orders. So whenever the buy order is triggered, they take buy. Whenever sell is triggered, they sell. So there is no set rule, and different algos do different things. Yeah, Sandeep, the premiums are actually too less. That's why I've been doing less expiry trading. The premiums are actually too less. Are most of them delta neutral? It depends, Pushpin. There are like a lot of different algos to different things. But see, if you have bigger capital, most of the people prefer delta neutral trading rather than directional trading. See, even if I do 500 lots, basically that is 10,000 bank nifty. If I keep a 20-point stop loss, I lose only 2 lakhs. But if I do 1,000 bank nifty, I have to at least keep a 100-point stop loss, right? Which is the smallest. I lose 10 lakhs. So non-directional is, that's why you can scale up also and you can manage your trade. That's why like most people with like larger capital mostly prefer non-directional trading, because you have the time edge also, but it has its own risk and own reward. So what they do is, so basically they cut the position and they move. So for example, if they create a straddle at 29,500, market goes to 29,600, they exit 29,500, create another straddle at 29,600. Market goes to 29,700, exit the straddle again, create at 29,700. And what most people do is they don't manage, they keep a stop loss, 50-point stop loss. Yeah, everyone makes losses in the market. There's no one who always makes profit. See, most of the people think algos do not make losses. Algos, everything it's the human who builds the algo, right? Algos also, it will do what you tell him to do. So they also make losses if the market moves violently. Right? Anyone has any other questions? See, most important takeaway I want you all is to think in terms of system building. See, if you think every system which I explained had a certain logic behind it and how it was built. So you have to think in those terms if you want to build any other strategy in the future also. Right? And try to run 2 or 3 different strategies which are like non-correlated, so that your drawdown is at the minimum. Is it clear? So there's nothing much for me to share now. Like, if you have any other questions, then we can take it. Else, like, I end this meeting. If you have any other questions, like no matter even if it's basic, you can ask. So hopefully you all learned something. Even if you're trading in the markets before, hopefully you take something home and like able to apply it. Thank you, Ashutosh. So now you have so many systems, you have to figure out what you want to do and what you want to avoid. So first thing, ask what you want from the market and what are your circumstances, what you can achieve, and decide which system you want to trade, and work on your psychology, work on risk management. So slowly, it will happen that you will become more of a disciplined trader and maintain your trade journal also. I was thinking quant will mean a lot of math, but I'm surprised it's not. Yes. See, as I said, like simple things works the most in the market. If you see every strategy which I showed as a simple logic, I explained in a basic manner and I explained the concept. So the volatility crush, if I wanted, I could have made it complicated also, right? By showing you relation between volatility skew, HV, IV, use some 3, 4 big terms, right? Wall dispersion, anything. But see, simple things work but you have to have a sound logic before creating any strategy. So theta decay, if I would have explained the Greeks in a Greeks manner, it would have been difficult. But simple things works the best. And there are certain complex things also, for example, as pair trading. That's why I didn't discuss it. But it's not even required. Right? Yeah, Puneet, the quant is basically just a fancy name. It's basically using data. But if you can see, if you even if you do this, you will be in the top 1% of the traders. That I can guarantee. Thank you. Yeah. Okay, Sarvesh. Yeah. So if you see, I generally like I don't like to talk much about Greeks because most people don't. But if you are trade option trader, you should it should come intuitive to you. When you take a trade, you know, okay, I'm shorting option. The risk is gamma. When is the risk highest? What will I do to mitigate it? As I said, contingency plan is very important. What is your risk in every strategy? You should know before that strategy before you take the trade. Can you share any good books on price action? Yeah, so I'll share 2 3 books. I'll ask Dhiren to share with every one of you all. And advanced option strategy. See, there are nothing called advanced option strategies. Strategies you have to build as per your market. There's something called as calendars. You can do credit spreads. You can do a lot of different strategies, but it is all depends on the situation. So I'll share a book by Guy Cohen. It's a very good book. You can like it is mentioned not a lot of strategy, but I don't try to remember the name of the strategies. I try to do what the market is saying, and accordingly, I build my own strategy. Can I apply same to US markets? See, Sandeep, you have to test it in the US market first, right? See, I have tested for the Indian markets. So whatever instruments you test, you can trade those instruments. Does not mean I tested in the Indian market, so it will work in the US market. It can, it cannot, but you have to test it, right? Thank you, Purvi. Good mathematical strategies based on options book. What does it mean, mathematical strategies? If you want to like, if you are more inclined towards the maths part, there's a book I will share with you all, the Sheldon Nettenberg. So like volatility pricing. See, a lot of people like don't have a maths background. So I basically have a maths background, engineering background. So it is relatively easier for me to understand statistics and a lot of the things I did during my CFA also. So yeah, so you can read this book by Ian Sinclair. I'll share the link with you. This is a good book on volatility trading, but it requires a background in math. Like because it talks about the pricing and everything, so you should be able to understand it. Today I tried to keep it simple. I didn't go much into the statistical, the mathematical part. And one more book is this. Option volatility and pricing, to understand how does option pricing and everything works, right? Thank you, Abhishek. CFA, yeah, not helpful for trading, but CFA is helpful if it helps you in generating a macro view. Like now I understand things better in a macroeconomic perspective. But for trading, I don't think it's useful. For trading, you don't need any degree. See, lot of the prop desk which I train, there are traders who are even 10th past but making crore of money every year. For trading, you don't require any degree. In fact, the lesser knowledge you have, the more better trader you are. See, because if you are a class topper, you always want good accuracy, right? But in trading, you don't aim for good accuracy. Just manage your risk. That's the only thing I can say. Even if you take trade on based on tossing a coin, manage your risk. And if you have a risk to reward of 1:1.5. think like a casino, and like you have to be the casino if you want to survive in the markets. See, with times markets will become more complex, and so if you are trading on simple things which everyone knows, everyone can, moving average strategy, people have become millionaires by trading the moving average crossover, the total trading system and other systems. But now it does not work because the edge is gone. So try to build your strategy in such a manner that you know how to refine it, what to do, what not to do. Is it clear? See, trade, it does not mean from one day, like from tomorrow you'll become an expert trader. It will definitely take time, but it's a good starting point, and you can definitely build a lot on this. So see, all this I didn't learn from a single trader. So basically, if I want to learn anything, I don't hesitate. So if you want to learn anything, don't hesitate. Message anyone. So I have met even the top traders at Goldman Sachs, Deutsche Bank. I just message them. I keep messaging them. One day, what will happen? So when I started the markets, my dad's friend, he was in Edelweiss, and he was making 100 crores a year for the company. I was like, how can someone make 100 crores just by buying, selling? So I got interested. So, but he was at a big post. So I just messaged him once. He did not reply. So I kept messaging him a lot of times. So finally he said, okay. He told me he used to, we do exotic options and something. I was like, what is exotic option? I don't understand. Then I started this, and now I am training his company. You can check online, Samir Doshi. So now I am training his company, Marwadi Shares. So now he's the CEO of that company, and now I'm training them. So times can change, but you have to be first. You have to, if you want to learn, be shameful. Message anyone, but have some courtesy. But you have to have that eagerness. You want to follow that thing, right? If I wanted to learn, you have to, okay, you have to see who is the best in the business. Okay, what can I learn from him? Okay, next, what from whom I can learn, right? You have to keep doing that. How can someone join trading desk to take some experience? See, trading desk, you see, basically there are a few companies such as Futures First, Caves, and like Marwadi Shares, a lot of prop trading desks, but you require a track record. And Futures First generally comes to only engineering colleges, and they ask question based on maths. So you should be good at maths, and like, and they have a training program. So if you go at these companies, you'll definitely learn a lot. How should we proceed to start a trading journey? Like, what should be a plan? Okay, Purvi. So there's no fixed answer to that. First of all, you have to see what is your background. Okay. On the basis of that, you have to decide how much capital you are willing to allocate to the stock markets for trading. Okay. Suppose you allocate, I am giving a rough number. It could be less, it could be high. Suppose you allocate 25 lakhs. Then you have to see, okay, I've allocated 25 lakhs. I want to, what is the amount I want to generate every month? Okay, this is the amount I want to generate every month. What all strategies will I follow? What is the risk will I take? Do I have the psychology to handle the losses? So slowly, what all instruments will I trade? So see, I like Bank Nifty because it suits my psychology. You can trade any other instrument also. So with time, it would take time. So that's why start small. Initially, for the first year, start with a small capital only. And as you grow with time, you can increase the capital. Right? So start, don't focus on returns. Focus on consistency. First, if you start with 1 lakh, try to make that 1 lakh into 2 lakh. People think if they have big capital, they can make more money. No, if you cannot turn a small capital, cannot compound a small capital, you cannot make money with a big capital. So first try small. Don't do the futures market, do the cash market. Try to learn. Okay, and I think Soumya is also doing kind of some trading, so you can like get perspective from him also. But try to build your psychology. I would say try, and don't once you have your system, don't listen to anyone else. No matter what they are saying, you have to follow your system. Okay, Purvi. And in the Python class, like you will be doing backtesting. Your everyone will be doing their backtest of their own strategy, so you learn more also on that, right? And we have a WhatsApp group, so I'll share the trades, you can observe. But see, you have to give time. Most of the people think trading is easy. You have to give time. So when I started, I used to observe markets entire day. I used to like see all charts. I used to give time. Like you have to give time if you want to be successful in the markets. You have to give time. You have to find out ways what works for you. So the strategies, it was not clear from day one. Okay, I'll do straddle, I do triangle. It's from trial and error, right? With times they'll refine further. So that effort has to be there. It does not mean I have told you to do this, you have to do that. You can refine it further also, right? Just make sure you don't risk lose lot. Observing markets, yes, any day. Observing the markets is like very important, and that's why I don't believe in paper trading. See, what people do is they paper trade. In paper trade, there is no emotion involved. There were interns from IIT at my in winters. They were saying, "Sir, today I made a profit of 10 lakhs because they in a paper portfolio they bought 1,000 lots of Nifty." But practically, can they do? No, right? So that's why it's important to, even if you do, even if you lose 100 rupees, it's fine. But you feel that you lost something. So that's why don't paper trade. Trade is a very small quantity that is actually like it will affect you. If you lose 200 points, you will feel that you lost something. So actually observe the markets, do some trades. Even if you do one lot only. If you're doing Nifty or Bank Nifty, do one lot. If you want to trade futures, don't trade futures. Buy 1/5 of the quantity in cash market. Right, so observe, everything is market observation. So if you see, my edge in Bank Nifty is mostly on the market observation, and some things I cannot even explain. Some things comes like I don't know, but it comes naturally, and that everyone has about, if like it will come to you with whatever instrument you trade. So everyone has their favorite instrument. So with time you will also find something in some instrument which you understand better. So a lot of people understand Reliance better, but I don't understand it. So it depends from person to person, but you have to give that time, observe the markets, and don't be greedy. Okay, I want to become like I want to make this much money. Just define how much you're willing to risk every day. So in the start, try to make a lot of mistakes. Even if your capital allocate 1 lakh, even if you lose at that is fine, but try, you should lose that over 100 trades, 200 trades. Don't lose it in one trade. So at least you would have 200 different learnings. Right, so initially if you're starting, you allocate a small capital, observe the markets, take small trades, just see what is happening, note the trades, note the in the trading journal. Again, every week review. Next time, once you get the confidence, from one lot go to two lots. Again, more confidence, 2 to 4. So slowly keep increasing. Right? Yeah. So okay, and I think Soumya is also doing some trading. I don't know if it's trading or investing, but yeah, but at least he can give you some market perspective. Yeah. Anyone, anything else? See, in India, trading is not a respected profession. Like when I started trading, people used to ask me, "What do you do?" I used to say, "I am in the stock market." So they used to say, "Okay, और क्या करते हो?" Like people think it's a side business. You cannot do it full time. So, so that's why, like, so a lot of the people, like families, don't even allow derivatives trading. So it all depends on your circumstances, on your skill, and how you prove yourself. So derivatives trading is definitely risky. If anyone tells you, "I'll give you fixed this much amount of money every month," so just run away. So derivative trading definitely risky, but you should know how to manage the risk, how to like trade. Think like a casino, and then only enter the markets. Rahul, like that, no one can tell you, right? Can you tell where will market bottoming out? I cannot tell that. That's why I said I don't have any view on the market. If it's going up, I'll buy. If it's going down, I'll sell. But I don't think it will bottom out soon. I think we'll again retest the lows. That's my opinion, which I feel. You can check the charts of 1929, 2008, and 2020 and compare. I think we'll again, so 10,000, around 10,000 level was a pullback I was expecting. But I feel like again we might hit lower level also, but cannot be certain about it. So you cannot predict the markets. As I said, don't try to predict. Try to follow what the market is doing. And market does not where the Nifty does not matter to you, right? If you are investing in the right stocks. That's the first thing I covered yesterday. If we know mathematics, what kind of other strategies we can build? So you can build strategies based on like volatility dispersion. Then you can build strategies based on statistics. For example, in pair trading, we use Z score and co-integration, other factors to build strategies. So that a lot of different things you can do. But I didn't want this webinar to be complicated and more mathematical. That's why I skipped those parts. But you can do you can do a lot of arbitrage. A lot of different things are there. On the put call parity only you can create strategies. Is it clear, Sandeep? The recent crash was very unique. I think happened in a very short amount of time. Oh yeah. So yeah, box strategy, the payoff. I don't like the payoff. The recent crash. Yeah, it was like very fast and furious. So that's why I said, na, anything can happen. Any people were thinking that 2008. People used to compare things with 2008. But we saw history in the making in 2020. So now going forward, people will refer to 2020 now. So don't. So whatever you know does not mean that things cannot go worse than that. So 2008, people said that this is the worst to ever happen in the markets. 2020 was even faster and furious than that, right? People never thought that a stock like Bajaj Finance could correct 65%. Right? So manage your risk, right? These things will keep happening. If you're in a market, you should not worry about all such things. This will keep happening. But you have to manage your risk, then only you can survive in the market. Any other questions? Are you aware about how to create Beardor or Jeep strategy? See, I have I think who does it? I don't remember the name. Someone on Twitter does it. So basically, I don't know what as I said, I try to remember the name of the strategies. Yeah, Pran Cutter. Yeah. So I don't try to remember the name. So basically, you buy one option and you sell. Basically, it's creating some kind of ratio spreads and then buying again far OTM kind of such things. I guess he does. I just saw payoff once, but I don't think it's required. Like you can do whatever you want to do. Like you can create the same strategy dynamically also, right? You don't have to give any name to it. I think then like if anyone has no question, then I'll end the meeting. I'll share everything with you all. The video access will be only for a week, so if you want to revise, quickly revise it, right? And the videos you won't be able to download also because like it will be encrypted. Python you learn with time, Sandeep. Yeah, Python will take time. So like whoever your mentor is, you can like keep connecting with him. See, Sandeep, Python will take time, but it will definitely help. I can guarantee that it will definitely help you. So after 2-3 months, you will be comfortable with it. But try to practice. You have to give enough time. Okay. Thank you, everyone. Then. Thank you. Yeah.